We still think we're in a bull market.
We've got to accept the fact that we're in a narrative-driven market.
We do wonder if we're starting to get to peak levels of sentiment.
We've got price-earnings ratios which are close to the dot-com bubble peaks.
There probably should be some kind of a pullback. My guess is it'll be lighter than you think.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday as stocks advance, equity markets inching higher after TSMC lifts its outlook for revenue. Secretary Besson floating the prospect of a long-term trade truce with China, and Fed officials keeping the door wide open for another rate cut when they meet later this month.
So basically right now what you have in the market, potentially investors breathing a sigh of relief that there is going to be an outcome that they like when it comes to the most recent heated rhetoric between Washington and Beijing. Remember in May we had that truce when tariff levels were as high as 145%, and then it was 90 days rolling basis. Well, the Treasury Secretary is signaling we might want to do something more than 90 days. It doesn't mean we're going to get a full agreement between these two economies at the end of the month. This likely is going to bleed into 2026. But what we do know is that we might have more clarity, and it's not just going to be these 3 months increments.
I'm pleased you remember May, because I remember very little about the last 6 months. 6 months since April 2nd and Liberation Day, and this market has just ripped. We've been waiting and waiting for a Federal Reserve decision about leadership, not just about whether they cut rates, don't cut rates over the next couple of meetings. Secretary Besson's narrowed it down to 5. We know that one of them is this guy right here. Governor Waller joining this program in 90 minutes time, 7:30 Eastern time. A lot of questions about the future of this institution.
Absolutely. Who is going to lead the Fed in a post-Powell environment? Also, a lot of questions for him regarding what we just heard from the Fed yesterday when it comes to the Beige Book, Jonathan. This quote stood out to me. Prices rose further during the reporting period. Tariff-induced input cost increases were reported across many districts, but the extent of those higher costs passing through to final prices varied. What is he seeing in terms of that inflationary story potentially with tariffs at the same time that we have the President of the United States saying out loud what you and I have been talking about since April? We're in a trade war with China.
That conversation, 7:30 Eastern time. Don't miss it. Equity futures so far this morning up a third of 1%. Coming up this hour, we'll catch up with Brian Levitt of Invesco, with equities pushing higher on stronger earnings. The former senior White House trade official, Kellyanne Shaw, as U.S. stocks look to extend on the China trade truce, and Frank Lee of HSBC with a street high price target on shares of Nvidia. We begin this hour with stocks inching higher following some big earnings beats. Brian Levitt of Invesco writing, it's not a significant surprise to see the banks reporting good results. It's reasonable to expect 7 to 9% earnings growth this quarter. There will be clear haves and have-nots. Brian joins us now for more. Brian, good morning.
Good morning.
Banks were solid. Any reason why the tech won't follow in 2 weeks' time?
No, I don't think so. I mean, the tech results are likely to continue to be very robust. Particularly you look at the semiconductor businesses, they're talking about demand that's almost insatiable at this point. Can they even continue to deliver or meet the shipments for all of this demand? So no, this is a very robust period. We've heard about all the AI infrastructure investment, and that's continuing to drive earnings.
They're the haves. Who are the have-nots?
I would say the have-nots. I mean, we've certainly seen what's happened with energy prices. So, you may have some challenges in energy. You just talked about some inflation. There could be some challenges in particular consumer groups. So it's not a rising tide that's lifting all boats, but it's certainly an environment where the macro still looks good. Fed's going to ease. Earnings are continue to be good. It's still a good backdrop for risk taking.
But what has been impacting the market, and we saw this on Friday, we saw this on Monday, is Trump's truths about trade. How are you thinking about the heated temperature brought up between these two economies, even though the Treasury Secretary is signaling we will at some point get to an agreement that might be more than 90 days long?
Yeah, I'm trying to use recent history as my guidepost. We get this market volatility.
Recent history this year or Trump won?
Recent history, maybe a little bit of both. I mean, in Trump 1, I think the key thing to remember is that inflation did pick up on tariff-impacted goods, but quickly returned lower following that, and the Federal Reserve actually cut rates in 2019. So that's critical. But with regards to the policy uncertainty, we're going to get volatility in markets. You'll get a spike in the VIX anytime there's policy uncertainty. But this market's gotten used to the administration putting these announcements out there as trial balloons or opening salvos in negotiations, and then ultimately getting to a better place place for markets. So until that changes, I will continue to try and look through the noise of these big announcements that are being made.
So you don't think this time is different, which is a question we've been discussing on this program for a few days?
I don't think this time is different. I think that ultimately it's in the best interest of the U.S. and China to come up with some agreement on this. It doesn't mean that you get to the most optimal trade agreement. And I think that's, a challenge that we've all had this year is you have to realize it may not be optimal. Right? Tariffs result in less optimal outcomes. Consumers will pay a bit of it. Corporate margins may be hurt in some places. But what's going to matter most for the markets is this idea of clarity. Let's set the rules of the game. Countries and businesses will adjust, as we've seen this year, and the markets, I think, will continue to move on.
Well, let's talk about where we do have clarity. Earnings have been decent so far. Early days, I know. We've only had the financials, but you expect more of the same from tech. The Federal Reserve has cut interest rates. Based on the communication from Chairman Powell this week, it looks like we'll get another reduction at the end of this month. It feels like payrolls and the softness we've seen in payrolls is a little bit of an outlier compared to what we see elsewhere. Is that fair?
It hasn't been a robust economic environment. I mean, you're certainly seeing the AI infrastructure spend offset some of the weakness you're seeing in other places. And I would presume that a lot of the weakness in payrolls has to do with this AI build out. There's this uncertainty on businesses on how many more workers are they ultimately going to need. What you also see is you haven't seen jobless claims jump significantly. So the unemployment rate has remained relatively low. But the weakness in payrolls is ultimately why you're getting rate cuts. So I sit back and I look at all of this, and I've got the real economy doing okay, not robust, but okay. Earnings look good. Yields have come down. Oil prices have come down. The Fed wants to cut interest rates. I've got a lot of people bearish to me or very concerned. And I'm sitting here looking at this saying, that's a pretty nice macro backdrop. I don't know if my compliance department wants me to say Goldilocks, so I won't, but that feels like a pretty nice...
Sounds like you're pretty close to saying it.
Yeah, no, I didn't say it. That feels like a pretty nice macro backdrop.
Let's talk about the energy story as well. So energy has come down. Yeah. Crude's had a big correction. On top of that, we have had that loosening in the labour market too. Is that sufficient enough to sit here and say we don't have to worry about inflation, given the trade story?
I'm watching the inflation break-evens, and I'm watching expectations in the bond market to give me a sense about it. So I know that the consumer price index is going to tick higher. I know that we're going to get these reports that perhaps scare the markets on certain days. But ultimately, if I have a 3-year inflation break-even sitting in the 240s and not budging, then to me, that is price stability. Right, that's price stability where I come from, and that's what the bond market, that's what the Fed's going to be focusing on. And so if you've got weakening in payrolls and price stability, then it makes sense to bring rates from what is generally a restrictive stance right now. Let's not think of this as significant easing. We're just getting rates back towards what I think a lot of us would consider to be neutral.
What does it tell you that a non-yielding asset has rallied 60% so far this year? And I'm talking about gold.
Well, a lot of that is, in a world of real yields, I mean, you and I know this, in a world of positive real yields, you're not supposed to love gold. So there's something else at play here. I keep hearing about this debasement trade that, the U.S. dollar is going to be debased and you have to own gold and Bitcoin. The reality is since July, the U.S. dollar is up 2% on a trade-weighted basis. So, gold is central bank diversification. That's really been happening since 2022. There's a lot of geopolitical uncertainty. I think gold makes sense in a portfolio as a hedge against some of these risks. What I worry about is people speculating on it now that you've had a pretty big move. But for all this talk about debasement, Jonathan, I've seen interest rates in the U.S. go from 4.80 to 4% this year. I've seen the S&P 500 advance mid-teens or wherever we are year to date. That is not people running away from the U.S. dollar.
If we go back to energy for a moment, you're right. Some energy is coming down, but not all. What's going to be the inflation picture when you have electricity prices continuing to rise next year as we have massive CapEx on AI data centers? Yeah,
so part of the challenge is, and what the Federal Reserve is going to do is try and strip out some of these more volatile categories to get a better understanding of what core inflation looks like. And, and I think of things like electricity or gasoline, those tend to not result in inflation spirals. They tend to be more of a tax on all of us. So if you get these spikes in your utility bills or what you're paying at the pump, you're less likely to spend on more discretionary items, and other core goods tend to see inflation either flat or even moderate some.
But whether it's the Fed reaction, the market reaction, how is it going to look at the end of the month when we don't have potentially the labor market report, but we have a higher inflation?
Yeah, I guess that's a little bit of a challenge. I mean, we're going to have to lean a little bit on private sector employment reports right now, and I'm focusing on the inflation break-evens. I'm not worried about consumer price index because we know where it's going, right? Tariffs are going to lead to higher prices. The question is whether this is becoming unsustainable or a sustained inflation spiral.
Yeah.
If we have price stability, the Federal Reserve is going to cut in a weakening payroll environment.
Market-based inflation expectations haven't broken out, not in a material way.
Not even a little bit. If you looked in 2022, when you saw the market-based inflation expectations start to move above 2.75%, 3%, that's when the Federal Reserve had to start to signal significant rate hikes, and that's when you saw a sell-off in markets. We're not even close to that right now.
Brian, it's good to see you. As I often say, my favourite FOMO guy, Brian Levitt of Invesco. Thank you, Brian, for dropping by. I'm with you on the electricity prices. It's going to be more and more important, maybe not for this Federal Reserve, who will strip out energy, of course, from the way they look at inflation. We can debate whether that's a good or bad thing, but certainly for the politicians down in Washington and across this country.
Absolutely. It's already coming to roost for some of these individuals that are hearing from their constituents, especially places like Texas. We're seeing a ton of money go to the AI data centers and the build out of the supply chain when it comes to supporting the AI industry. Electricity prices are going higher. If you're a consumer, you're paying higher electricity bills, guess what? You're not spending on other things.
Later on this morning, 8:30 Eastern Time, so 2 hours and 20 minutes away, we'll catch up with the US Energy Secretary, Chris Wright. Look out for that conversation later on this morning. We'll talk about AI, electricity prices, and what they can do to support energy in this country. Before we get to all of that, let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. US Treasury Secretary Scott Bessent proposed a longer pause on high US tariffs on Chinese goods. That would be in return for Beijing putting off its recently announced plan to tighten limits on critical rare earths. Speaking at a news conference in Washington, Bessent said there's a very good chance that he travels to Asia to meet with his Chinese counterpart, Vice Premier He Li-feng. Elsewhere, President Donald Trump says that he's authorized the CIA to take covert action in Venezuela to stem what he says is the flow of drugs and illegal migrants into the US. He was responding to questions about a New York Times report which says the agency would be enabled to carry out lethal operations in Venezuela. And Apple's been hit with another high-profile exit from its AI division, with the executive leading its Siri search project leaving for Meta. Qi Yang headed the team developing ChatGPT-style features for Siri in a major revamp due next March. His departure adds to roughly a dozen key losses from Apple's AI group this year as Meta continues its big money hiring spree. And that's your Bloomberg Brief, John.
Hey, Lizzie, thank you. More from Lizzie later this hour in about 30 minutes' time. Up next on the programme, decoupling with China.
China wants to be an unreliable partner to the world, then the world will have to decouple. All that's going to be negotiated in the coming weeks before the leaders meet in Korea.
On the prospect of a long-term truce, we'll speak to the former senior White House trade advisor Kellyanne Shaw, live from New York City this morning. Good morning. Coming up on Bloomberg Surveillance later on this morning, 1 hour and 15 minutes away, this guy right here, Governor Chris Waller of the Federal Reserve at 7:30 Eastern Time, following a pretty cool speech yesterday on the innovation at the speed of AI. We'll get into that and what it means for the labour market, the broader economy, what it means for policymakers, and hopefully get some insight into the race to replace Chairman Powell in May next year.
I'm just interested to know what has been the tone and tenor of these conversations when you walk in. Based on what we know, how Trump handled hiring of Powell in Trump 1, the one question the President of the United States had was, are you willing to cut interest rates? Yes? Okay, you got the job. But what has been the rapport between him and the Treasury Secretary? Because that's almost just as important to get to the next leg to then get in front of President Trump.
We'll give Governor Wallace some space to answer those questions a little bit later this morning. Let's find some time to talk about this market. Equity futures and this market more broadly over the past 4 sessions whipsawed by trade tension between the US and China. We're positive by 1/3% this morning on the S&P, on the Nasdaq up by 0.5, on the Russell up by 0.3. Under surveillance this morning, decoupling with China.
China wants to be an unreliable partner to the world, then the world will have to decouple. Right now, we are currently in a 90-day roll on the tariffs. So is it possible that we could go to a longer roll in return for a delay? Perhaps, but all that's going to be negotiated in the coming weeks before the leaders meet in Korea.
So here's the latest this morning. US Treasury Secretary Scott Bessent floating the prospect of a long-term trade truce with China if they walk back plans to curb rare earth exports. Bloomberg's Jack Fitzpatrick joins us now for more. Jack, how are things shaping up, going into month end?
The Trump administration wants to give themselves some carrots and some sticks. And so while you heard some dramatic talk about the damage of these Chinese plans on rare earth minerals and start discussing what they might do with India and Australia and Canada to try to move them away from Chinese influence over that kind of trade. You also heard the possibility come up of some sort of truce, at least longer than the 3-month periods that they've been relying on now. As they look towards the beginning of November, a possible meeting between President Trump and Xi Jinping, as they look towards just the deadline to decide what they're going to do with the current truce, you see them stacking up trading chips, stacking up opportunities to say we can make this better or worse for China, to at least at this point over the next couple of weeks give themselves options in those negotiations. It seems like an administration that's keeping their options open and making sure that in a couple weeks they have something to say that could be good or could be bad for their Chinese counterparts.
I think, Jack, you're absolutely right. We've all got to acknowledge that this is positioning for negotiations month end. But pretty interesting that yesterday the Treasury Secretary essentially revealed private conversations with a Chinese negotiator, a lower level diplomat, sure, but still revealed just how contentious some of those comments actually were late in the summer.
Yeah, they got into it early in the press conference yesterday regarding a Chinese diplomat who they didn't want to be in Washington, who they said used very contentious language. On one hand, any news from the Trump administration on what they're doing to continue communication with China and not simply walk away, it could be characterized as good news. But the tenor and the description by Scott Bessent about some of the lower level kind of behind the scenes conversations definitely revealed tension and frustration. So again, this is an administration that's willing to push back hard and to publicly express frustration with their Chinese counterparts. The stick is certainly on the table, as well as any carrots they may be offering up.
Without a doubt. Jack, it's good to see you. Jack Fitzpatrick down in Washington, D.C. Joining us now to extend the conversation, the former White House senior trade advisor, Kellyanne Shaw. Kellyanne, welcome back. China flexed in the last week. They flexed their superior rare earth refining capacity. How should the U.S. and the rest of the world respond?
Good morning. Thanks for having me back on. Well, this is certainly what has dominated the last several days of my life, is trying to understand exactly what's happening, the dynamic here behind just the headlines and the top line messaging. But what seems very clear to me is China reacted in a way that was much more aggressive than anyone on the U.S. expected. And the real question for me is whether this is an overreaction, a miscalculation by China, in which case we might see them pause some of these measures, potentially look to change the way that this is implemented, if not roll back, or if this was indeed very strategic and an intentional action by China to say, we're going to just solidify our chokehold on the rare earth magnet supply chain, and we don't care what that means for the trade talks. And so we'll really see what China does here to truly understand what their motivation was.
If it's the latter, does China walk into the negotiations with a lot more leverage than the United States, which seems to be talking about cooking oil and soybeans?
Well, cooking oil aside, what the U.S. administration has said is they have their own choke points. I mean, what we are talking about are the world's two largest economies, whose economies have been interlinked for the last several decades. They're world superpowers. They each have chokehold and choke points on one another. And what we're seeing the administration do is give China a very long leash. You're hearing them say, we're going to work this out. We think China's going to come to the table. We think we'll be able to de-escalate. That's a salvo to China to say, we don't want to have to pull these triggers, but we will if we need to. And I don't think that's going to be good for the world if that's where this ends up.
When the Treasury Secretary signals the potential for a longer truce, more than 90 days, what kind of off-ramp could you see both sides agreeing to get to that point?
Yeah, and so this is where this relationship and this negotiation becomes very hard. And this is where we've talked about the fact that managing the relationship, effectively keeping that status quo of trade in some sectors continuing while both sides continue to take national security measures, is effectively the best outcome we can get to. Again, these are two very difficult positions. In some respects, they might be intractable. But here, I think you heard very clearly the administration say publicly that they're looking for China to, at a minimum, pause the moving forward of these rare earth restrictions and pushing for them to roll this back. Now, I don't know if that's what China's going to do. I think things are going to effectively fall off a cliff if they don't. But the administration is relatively optimistic that they can at least get a pause. And so that's really what you're hearing play out here.
Kellyanne, you were there in the room for Trump 1. That took 18 months when it comes to the agricultural purchase agreements. How long do you think this is going to take? Does this story bleed into 2026?
My own view on this is effectively the status quo. I think that we will continue to see potential progress in some areas, maybe relief for individual companies who are facing issues, small wins, maybe things like soybean purchases, which the president has talked about publicly as something he's expecting as a potential deliverable. But what I don't think you'll see is a broad phase 2 agreement. Again, you've got the world's two largest economies with very different economic models, very different foreign policy models, who are just really trying to manage this relationship without it totally falling off a cliff. I don't know that we're going to see a grand bargain. I think really just seeing a pause here, seeing a little bit of progress, that's the best case scenario.
Kellyanne, it's been interesting to follow the markets. They've got a new proxy just to take the temperature of this phase of tension between the US and China. It's anything to do with rare earth minerals. And on days where there is clear tension between the two countries, the two sides, those names, those stocks absolutely explode. They rally really hard. When things start to die down, they start to roll over. And Kellyanne, I'm just sitting here, I get it. It's a bit of a game in the market at the moment. But is that ultimately inevitable that more money's going to that sector anyway? More money's going towards those names to try and build out that capacity here in America?
Well, I think this is an issue that should have been addressed with more earnest years ago. And different U.S. administrations have tried to deal with the critical mineral and rare earth challenge, the fact that China manipulates the market, the fact that anytime a new entrant goes in, China will crash the price to make that a less profitable business. So clearly there is a need for more significant government intervention in the sector to try to correct this market distortion and frankly, secure U.S. national security interests. I do think that this is what it's going to be. It's going to be a U.S. takes a step, China responds, China takes a step, U.S. responds. That's going to have implications for the companies who are trying to dig these minerals out of the ground, to refine them and to process them. So I agree. I think the market's going to follow a lot of this geopolitical drama.
Kellyanne, good to see you. Kellyanne Shaw, the former senior White House trade advisor on the latest situation between the US and China. It's like trade war on, trade war off. That's how the market perceives things. But ultimately, you just have to look across, say, several years, where we were and where we are now. Look over several months, where we were and where we are now. Ultimately, the tariffs are higher, and there's a greater push now than there was 6 months ago to invest here domestically.
Absolutely. And we saw this as well with the Biden administration. They did loans and grants. This administration is taking a much more aggressive approach, taking outright equity stakes in these companies. Intel, MP, what we saw last week, and also the president, Treasury Secretary, signaling this is going to be more of these types of deals. You can expect more of them. What's interesting, what China is doing is basically telling the United States, yeah, you should keep doing that because we are going to hold on to these rare earths and we are going to have a choke point on this.
As they keep flexing, they'll keep investing here domestically. Futures positive by 1/3% on the S&P. China not looking to make that transition easy. Let's put it that way. Up next on the program, Frank Lee of HSBC on his street high price target on Nvidia. So here's the state of play this morning. Equity futures positive on the S&P 500 by 0.4%, up 0.6 on the Nasdaq. No idea if this sticks because the swings have been wild over the previous 4 days. On Friday, biggest one-day drop since April. Monday, biggest one-day rally since May. Tuesday, 2 percentage point swing on the S&P. And yesterday, almost as much. Just about finishing positive, and we get some positive follow-through on the S&P this morning. The earnings have been okay. The Fed's on course to cut interest rates. This has been about a bunch of things, but really the main one, the US and China and the tension between the two.
And I wonder if potentially there's going to be an amped up rhetoric today. The former global editor of a massive Chinese newspaper, who sometimes comes out and talks about things that he's hearing behind the scenes, is really going after Scott Bessent this morning, saying that the act of publicly revealing unsubstantiated details from the negotiations is deeply unethical. They're saying this behavior shocks them, and I wonder if they take another hit potentially as these negotiations continue, because everyone wants max leverage going into that meeting.
The positioning for negotiations at the end of this month continues. Let's turn to the bond market. Yields slightly lower across the curve, 2s out to 30s. The front end anchored near a multi-year low on 10-year government bond yields, just above a year-to-date closing low on a 10-year, just above 4% at the moment, 4.02% on 10s, down, let's call it a basis point so far this morning. That's the cross-asset picture, 3 hours away from the opening bell. Let's get you some morning moves and cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John. Well, it is interesting on a day where TSMC is casting an AI glow over the market that you see Hewlett-Packard Enterprise down precisely because of AI. It's going to miss its annual profit forecast because of a margin crunch. Obviously, machines are less profitable because AI servers and the chips that are in them are much more expensive, and HPE is experiencing that. In fact, it's giving up half its gains for the year. It was up about 17% year to date before this. It did throw some bones to investors, an increase in a dividend, a share buyback, and even some job cuts as it integrates with Juniper Networks. Not enough. Let's move to United, because those shares are lower even as it forecasts resilient demand. Now, that demand is going to come from brand loyal customers as well as the premium segment. And Bloomberg Intelligence is saying with yields lower in every region in the globe, even that premium segment might be experiencing some saturation. We have to say United did get a little boost before this, though. Shares there up 7% this year. And then JB Hunt, well, it was a much needed quarter for JB Hunt. Cost saving measures really to be credited for its outperformance this quarter, because it has had a tough time. So have its competitors. Freight in general has had a very tough time. It's moving fewer empty containers, so that helps. And obviously, it's a profit beat, and that's what's giving it its 13% increase this morning, but down 19% year to date. So desperately needed, John.
Vonnie, thank you. More from Vonnie later on in the show. We'll get some more stock movers from Vonnie in about an hour from now. Just look out for an interview taking place later as well, just on United. Vonnie mentioned the move for United Airlines in the pre-market. We'll catch up with Scott Kirby. Lisa will be talking to the United Airlines CEO at around 8:15 Eastern Time. On our radar this morning, President Donald Trump confirming the US and China are in a trade war. This comes as the Treasury Secretary Scott Bessent is floating the idea of extending the 90-day tariff pause on goods from China if it halts rare earth curbs. Elsewhere, a California judge temporarily blocking the Trump administration from firing federal workers during the ongoing shutdown. An immediate restraining order halts the termination of over 4,000 employees. And finally, a major blow to Apple's AI ambitions. Executive Key Yang is leaving to join, guess who? Meta. Yang was the leading driver, the effort over at Apple to develop a ChatGPT-like web search for Siri. His departure is the latest in a string of high-profile exits from Apple's AI division.
What's so interesting about this is he was just tapped to lead this team, Answers, Knowledge, and Information, to develop this ChatGPT-like Siri infrastructure for Apple. So he was just given this role and pretty much was like, I'm going, because there is something better going on in terms of development at Meta. Apple is clearly not, show me the money. They're not showing you the money.
Obviously, Apple, based on some of this as well, and from what we're hearing, is that Apple is looking externally and not looking to build this themselves anymore. So if you're an executive leading this effort over at Apple, you're sitting there thinking, I want to build somewhere else, get paid more for it. Why wouldn't I leave? Is it that story or is it something else?
Well, if that's the case, then how far behind is Apple going to be if at some point they want to do these things in-house, which normally Apple likes to build from the ground up within, in-house. This is really the first time when it comes to AI that they're outsourcing all of this. If they decide one day to build this in-house, they've lost so much of the top talent to others, most notably Meta.
Meta and Apple inching higher in the pre-market and early trading. Let's stick with tech. HSBC upgrading Nvidia, expecting AI to drive 80% upside for the stock. Analyst Frank Lee now has a street high price target of $320 on Nvidia shares. Lee writing the following: we now see further potential upside to full year 27 estimated earnings that can surprise the market. Frank joins us now for more. Frank, welcome back, sir, and thanks for making time for us. This is a big upgrade, a big move in the price target for you and the team. Frank, what's changed? Did you change, or is it something the company's changed?
Sure. I think, we first got a little bit more cautious on NVIDIA early in the year because one of the things that we looked at was that the roadmap wasn't seeing the big ASP increases that we saw for the first 2 years of the AI cycle. But I think as throughout the year, what we're starting to see is that the narrative isn't really about the product cycle anymore, but it's more about how big the TAM market can be, especially for the GPU side. So I think that was the big debate in the first half of the year. And you see, if you look at NVIDIA, they've relatively underperformed year to date versus some of the other names because, I think if you look at the hyperscalers, it's been clear that they're moving into more ASIC. So Broadcom has become a big focus now. There's been also focused on AMD trying to gain some share. But I think what we've also seen is that Jensen has been very vocal about, there's a bigger market emerging in enterprise, sovereign. And I think that those markets have been hard to quantify. But I think the last couple of deals we've seen from OpenAI has really kind of expanded its TAM opportunity. So that's one of the things we see is that this TAM now could be a lot bigger than we anticipated previously. And secondly, I think the other thing that we also saw as a positive is the capacity allocation at TSMC, which has been a good indicator of overall momentum, it's been kind of stagnant since the end of last year until very recently. So as we go into 2026 next year, we see a very big increase in their wafer allocation at TSMC. So that also gives us confidence that Nvidia is seeing perhaps a much bigger market than previously expected, and that's what's driving their more bullish forecast at TSMC as well.
Frank, help us understand a couple of things. So it's been known for a long time that some of their biggest customers also want to become their competitors and develop their own chips. Frank, what's the strategy that Nvidia is developing to counter that?
Yeah, so I think this is something they've been alluding to quite a bit, which is they need to enhance their market beyond these 4 or 5 hyperscalers. And as you just alluded to, these guys want to start thinking doing their own chip. But if you think about enterprise and sovereign, these markets, there's not going to be an opportunity for ASIC in those areas. You need a lot of resources to big companies like hyperscalers to drive that. So I think that's the market that NVIDIA is looking a lot more closely now. NeoCloud is another group of customers that is going to expand NVIDIA's TAM market while reducing their dependency on these hyperscalers.
So Frank, I just want to build on the NeoCloud. So NVIDIA's strategy effectively is to sponsor these so-called NeoCloud companies. Now, Frank, some people might just describe that as vendor financing. Why isn't it that? Why is it something different?
I don't think it's wrong to say that is vendor financing. But I think at the same time, though, the market opportunity seems to be bigger and bigger. There's more application usage. If you think about, in some ways, the biggest potential vendor type financing company is OpenAI with all these deals they've done, right? Especially with AMD, they're getting equity to fund for future orders at AMD. So I don't think there's anything wrong inherently with that as long as the market can continue to grow.
Frank, we have the market whipsawing as of late regarding the hot rhetoric between Beijing and Washington. And an analyst on the call with TSMC was asking the CEO, how can you fare if you don't have as big as access to the Chinese market? And I want to ask you how you think Nvidia will fare if potentially they have less access to Beijing.
Yeah, that's a good question. We actually first highlighted that in August that the Chinese market was going to be more uncertain. I remember, I think at that time, everybody was quite excited that U.S. government was allowing NVIDIA to go back into China with a 15% rebate. But the feedback we got from a lot of our channel check was that the Chinese weren't as willing to take on the NVIDIA chips in the near term. Now, it could be part of the overall, strategy in terms of the trade, the trade deal between the U.S. and China. We do think that China is trying to localize more, but at the same time, the self-sufficiency is not going to be anywhere close to max level in the next 2 years. So China will still need to depend on the chips from NVIDIA. It's just that I think the H20 chip, which is what NVIDIA was allowed to sell, wasn't the chip they wanted. They wanted a better chip. And so I think right now we're waiting to see that. And as far as the actual earnings contribution to NVIDIA is concerned, well, China is a nice to have. it's not that big of a driver. Ultimately, it's hyperscalers, and now, these sovereign and enterprise guys like OpenAI are becoming, and NeoCloud is going to become a much bigger customer than just China itself.
Interesting. Frank, thank you, sir. Appreciate the update. Fantastic to get you on the program following that call. Frank Lee there of HSBC. Street high price target, 320 on shares of Nvidia this morning, south of 200. That's a lot of upside for that stock over the next 12 months, according to Frank Lee and the team at HSBC. Let's get an update on news worldwide. Let's cross over to Lizzie Burden for your Bloomberg brief. Hey, Lizzie.
Hey, John. French Prime Minister Sébastien Lecornu has survived the first of 2 no-confidence votes after announcing plans to suspend a contentious pension law. A second motion, tabled by Marine Le Pen's far-right National Rally, will be voted on later today. It's also expected to fail, with socialist lawmakers backing the government. Elsewhere, President Donald Trump says that the Indian Prime Minister Narendra Modi has promised to halt purchases of Russian oil. Trump said that Modi made the commitment to him during a Wednesday conversation, but did not describe an exact timeline for India's curtailment. Washington has repeatedly criticised New Delhi over its Russian oil buying, saying it was fueling the war on Ukraine. And shares of Nestlé rising in European trading. The company's new CEO, Philip Navratil, announcing plans to slash 16,000 jobs to build on a stronger than expected increase in quarterly sales. The job reductions will occur over the next 2 years and are part of Navratil's plan to increase Nestlé's target for cost savings to 3 billion Swiss francs by the end of 2027. And that should be my brief, John.
Lizzie, thank you. Appreciate it. More from Lizzie in about 30 minutes' time. Up next on the programme, a crucial question for AI.
A crucial question is whether AI will contribute to a resurgence in productivity growth. Layoffs and reduction in hiring plans due to AI use are expected to increase, from everything I hear.
That was Governor Chris Waller. We'll catch up with him in about 50 minutes' time. Up next on the programme, Jason Thomas of Carlisle. From New York City, you're watching Bloomberg TV. Futures positive by 0.4% on the S&P 500, on the Nasdaq up by 0.5%, on the Russell, small caps up by 0.3%. Under surveillance this morning, a crucial question for AI.
A crucial question is whether AI will contribute to a resurgence in productivity growth. Any sustained productivity growth above 2% will tend to support rising real incomes and living standards without inflationary pressure. Looking ahead, however, layoffs and reduction in hiring plans due to AI use are expected to increase, from everything I hear, especially for workers with a college degree.
So here's the latest this morning. Federal Reserve Governor Christopher Waller remaining hopeful about the impact of AI on the US economy. More Fed policymakers questioning whether AI will contribute to a productivity resurgence without fueling inflation. Lisa joins us now from Washington with a special guest. Good morning, Lisa.
Good morning, John. Thank you so much. Yeah, this is the crucial question. Exactly what are the ramifications of AI going to be? Not just when it comes to tech stocks, but also the broader economy. Jason Thomas, who is head of global research as well as investment strategy for Carlisle, joining us now. And Jason, you talk about this. It's maybe the wrong side of the equation, or not the only side of the equation, to just look at tech stock valuations, but also how it's really affecting how policymakers are thinking about the economy. Can you explain what that ramification or how that influence really is percolating through policy?
Yeah, when you ask policymakers or people in the administration or just other advocates of low rates, how is it that you can cut rates by 150, 200 basis points in an economy where we still have above target inflation? The answer always comes back to AI. And essentially what they're saying is, sure, the Fed may miss its inflation target for another few months, but whatever residual price pressures are there are going to soon be overwhelmed by this massive disinflationary shock from AI. So I think that that's embedded in expectations. And again, that provides the path to the lower rates. My worry is that this may confuse today and tomorrow. What I mean by that is what we've learned over the past few years, what's very obvious today, is that our path to this disinflationary agentic AI future is paved with trillions of dollars of investment in what are essentially massive, energy-hungry supercomputers. And that's extremely resource intensive. You have the demand for data centers, for infrastructure, for construction, GPUs, servers, other hardware, and especially, of course, power and generation capacity. And, the last time we had anything like this in terms of a concentrated CapEx boom of this magnitude, we had real interest rates that average nearly 4% from 1997 to 2000. What people are talking about today is taking rates down further, real rates to effectively zero. That does not seem at all consistent with an inflation target.
If you do have an inflationary ramification from the AI build-out, what does that imply for where rates should be, what the neutral rate is for the Federal Reserve?
Yeah, first, it implies that a neutral rate is higher. Anytime that you have an increase in fixed investment relative to savings, we have this shift since the pandemic in investment savings propensities. The fixed investment boom in manufacturing, it was, after the supply chain crisis, the need for redundancies, for additional warehouses. Then, of course, you had a green energy boom. Now this is transitioned really almost entirely to AI and the data centers, again, these supercomputers. So I think that this insistence today that the neutral rate is lower than where it is today, I don't know that there's that much evidence for that. And I worry that this insistence that you can move rates down closer to neutral, the neutral rate's unobservable, right? It's just an estimation. And I think that, again, it seems curious in the context of core PC inflation that's at 2.9%.
So this is a speed question. This is a question of whether we can get the efficiencies quickly enough to overwhelm some of the investment costs and the potential inflation to create this equilibrium where there can be this lower inflation. Ken Griffin was talking about how he's not seeing AI really create so much better in terms of pricing models for bonds. Do you see the same thing? I mean, is the efficiency not coming as quickly as you think the inflationary boom is going to come?
Well, so again, the boom in inflation, or at least, again, this resource intensity, that all this demand for construction, for the hardware, for power, is today. And again, we're talking, yes, in the future, I do suspect that there will be a disinflationary shock, but the timelines matter significantly. Of course, when we're thinking about the return on all this capital, timelines matter quite a lot, as you see throughout history, whether it was the internet or electrification or even the railroads. It's not a question of whether the technology is transformative. It's a question of when the revenues associated with the investment in the technology actually arrive. And I think recently what you've seen, some of the AI integration programs in the corporate sector, there has been some, they've fallen short of return on investment targets. In many cases, I think that is simply because you have essentially a solution in search of a problem. You have teams that are, here's the AI tool, figure out what to do with it. And I think sometimes that just takes time. Sometimes you realize that you have to learn by doing. And so I think that is a risk today, that this is just the timelines are being extended. And that's a very different story than whether this is, whether these gains ultimately don't materialize.
Given this backdrop, if the Fed cuts rates 2 times, which a lot of people are expecting, do you expect that long-term rates will rise significantly, potentially, if we do have an economy that is not only chugging along, but potentially reaccelerating?
I think that right now the risk for the Fed is to have a repeat of last year. They cut rates by 100 basis points in 2024, and you had effectively 100 basis point backup in long-term yields. So I think they want to be cautious of that. Today, though, I think they also need to look at the foreign exchange value of the dollar. They need to look at this meteoric rise in the price of gold, other commodities. I think that a lot of the people talk about a debasement trade. So I think that these concerns about policy perhaps being too easy, not today, but could be moving in that direction, is actually manifesting outside of bonds today. It could, of course, there could be a backup in yields that should be a concern, but I think that there are some worrying signs outside of the fixed income markets that there's concern about the direction of policy.
How concerned are you about some sort of rapid fire reassessment of how quickly some of these tech companies can invest in AI? And I just wonder what we saw, say, with Oracle a few months back, and this sort of tremendous plummeting in their shares, trading like a penny stock. Do you foresee more of that coming down the pike if right now AI, for a large extent, is a solution in search of a problem?
Well, again, I think that right now the most fascinating part of all of this from a market perspective, from at least the way I view it, is that you have these mega cap tech companies that have effectively exercised an option to change strategy. What I mean by that is really for the last decade longer, they've been essentially virtual companies, asset-light businesses, very common to generate $60 billion in cash from operations, maybe invest only 12 or 15 back in the business, this huge free cash flow to fund acquisitions, to fund special dividends, to fund share repurchase programs. Now, 70% of the cash from operations is going into AI. This can continue. I mean, the amount of money that is generated by these companies means that you have a 15, 18-month timeline. Oracle went into a negative free cash flow position. That was partly just this concern that, of course, they have this very large contract with a company that has only $13 billion in revenue. So a $13 billion revenue company pledging $300 billion in spending. Oracle had to increase their CapEx by about 47% annualized rate over 2 years to build the infrastructure necessary to make good on those commitments. So I think there was a reassessment there. But much, again, of the spending is by companies that have the cash to do it.
Just real quick, are you getting more cautious as you look at the potential for both rates going up and potentially a reassessment of how quickly AI adoption can take place?
I think that any time you have a market that is as concentrated as it is today, 40% of the market capitalization of the S&P 500 in 10 stocks, 8 of them have their financial future, really hitched to AI. So you're talking about an AI bet that accounts for about 25% of the total market capitalization in the U.S. I think that in and of itself is a reason to be cautious. Look for other ways to diversify. Of course, we recommend private markets. But again, I just think in general, having a sense of caution is very prudent at this juncture.
Jason Thomas, wonderful to speak with you. Thank you so much for your time. That was Jason Thomas. And John, I will send it back to you.
Lisa, thank you. Appreciate it. Fantastic conversation. More from Lisa later on this morning, 8:15 Eastern Time. Lisa's catching up with Scott Kirby of United Airlines. Look out for that a little bit later this morning on the programme. Fantastic conversation about AI and what it might mean for Fed policy. A conversation we'll have with Governor Waller in about 34 minutes from now. Could this be a source of tension for the dual mandate? Could it hold back employment, but also simultaneously boost and push up prices too?
Treasury Secretary was talking about this yesterday, the fact that he says when there's CapEx booms, usually there's employment booms. But how do you have an employment boom when the underlying technology's goal is to make life easier and at the end of the day, reduce the labor market, reduce the amount needed in terms of labor capacity to get a task done? There's a tremendous amount of inflation. And does the Fed even have the tools to deal with artificial intelligence?
Governor Waller's talking about the short term versus the long-run costs, saying we must let the disruption occur and trust that the long-run benefits will exceed any short-run costs. Economists are typically techno-optimists. We'll get into that conversation in the next hour. Joining us next, David Lebovitz of JP Morgan Asset Management, Alberto Gallo of Andromeda Capital Management. Look out for that. Plus, Governor Chris Waller joining us in just a moment, and reaction with Neil Dutta of Renmac. From New York City, the second hour of Bloomberg Surveillance. Up next.
We've got a tortoise of an economy. We're slowing down to a crawl.
There's no doubt that there is weakness in the jobs market.
The Federal Reserve is worried about the downside risk to employment.
It gives them kind of a free pass to take the cut here in October.
We've baked in what we can bake in at the moment, knowing what we know.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Big swings over the past 4 sessions or so. Equity futures this morning pushing higher by 1/3 on the S&P. On the Nasdaq, up by 0.5. On the Russell, up by 0.3. Up around 1/3 as we count you down to the opening bell. About 2 hours and 30 minutes away. As we look ahead to the week ahead, this is the data you're missing this morning. We would have had claims, PPI and retail sales. Not getting that with the government shutdown, but next week, next Friday, we're looking for the CPI report going into the Federal Reserve decision at the end of this month.
It's why this decision is so uncomfortable, because we could have a hot CPI print, but we might not have the weakening data from the labor market, because we will not have the labor market report because the government is still shut down and neither side is blinking right now. So how does the Fed communicate why exactly they are cutting interest rates into hotter inflation and no update on the labor market report when they consistently said to us, at least Governor Chair Jay Powell has consistently said we are data dependent?
How much clarity can you get from the private market indicators? We'll have that conversation too, of course. This is all setting up to be an interesting end to this month. Plenty of volatility over the past few days as the US and China position for negotiations. Just build up a little bit of leverage here and there, going into a conversation between the leaders at the end of this month. At the same time, we'll have that Fed decision and we'll have some key earnings from the biggest tech players on the planet.
Exactly. We want to hear what the mega cap tech companies are saying when it comes to their AI investment, what the Fed has to deal with and think about that, and how actually all of this is tied up in the trade war. The Treasury Secretary yesterday doing what the president has said he likes him to do, go out there, soothe the markets, because he said this: it's possible that we could go to a longer roll in return, perhaps, but all that's going to be negotiated in the coming weeks. What does he mean? We might get more than a 90-day extension, which potentially would give this market a little bit more structure and clarity on the direction of travel for this relationship.
Some positive follow-through to the price action this morning, at least. We're higher by 0.4% on the S&P. Coming up this hour, David Lebovitz of JP Morgan Asset Management as stocks rally on hot earnings. Alberto Gallo of Andromeda Capital Management as Wall Street weighs credit concerns. And a Fed Governor, Chris Waller, as a divided central bank navigates the data darkness. We begin this hour with stocks moving higher as earnings outperform expectations. David Lebovitz of JP Morgan Asset Management writing, in the absence of government-provided data, earnings season has taken center stage. We'll be watching for significant margin impacts and how quickly they materialize. David joins us now for more. David, good morning.
Good morning.
We're all familiar with the arc of earnings season. Starts with the banks. We wait a few weeks, then we get tech. When you're talking about margins, what kind of industries are you thinking about?
So I think it's really across the board. Obviously, the big tech names are going to be the primary driver of what happens to the level of margins for the S&P overall. But what we're really looking for is whether there's any cost creep, particularly in those more cyclical and goods-oriented sectors from the tariffs that have come into play over the course of the past couple of months. I think if you see some modest margin pressure, that's not necessarily the worst thing in the world. It's more so a reflection that the tariff impact is finally showing up, and that makes the management commentary that much more important. How are they going to deal with that persistent pressure should it prove to be persistent, which, recent news flow supports.
Do you think this is the make or break quarter where they've got to make a decision, pass it on or cut costs and take it on margin?
So I'm not sure that this is the make or break quarter. My assessment of the tariff issue has been that it's more of a slow burn than a big bang. And so there's kind of this mosquito buzzing around, bothering you a little bit, but it's not a big fly where the bite might actually hurt. And so as long as we don't see a huge surge in prices, I think that companies can eat some, consumers can eat some, and we can move forward to the beginning of next year when growth should reaccelerate. But if you were to see a big shock to the system, that's where I think the tariff issue would become much more problematic.
Fair to say the market's moved on, and moved on pretty quickly. 6 months since April 2nd and Liberation Day, we're higher by, close to 40%? This market's pricing in the reacceleration. Why do you think we're actually going to get it in 26?
So to us, the biggest thing is really the state of the consumer. And the big, beautiful bill is going to benefit consumers, some more than others, and we've all seen that analysis. But coming into it, what we're seeing from the alternative data, the government data that we were getting, our own proprietary Chase data, we're seeing that the consumer is frankly in pretty good shape. There is a divergence between income levels, lower income consumers more focused on value, but still out there shopping and proving to be resilient. That's something that's come through in a lot of the earnings announcements and conversations over the past couple of months, and guidance suggests that businesses are expecting the consumer to show up into the end of the year. And so you get that benefit in the beginning of 2026. To me, that's how you get growth above 3% in the first half of next year.
You get the benefit from the one big beautiful bill, but do not get the negative downside from what the Beige Book called yesterday, the tariff-induced input cost increases across all these districts in the United States.
So I think that the interesting thing about the Beige Book, and at least we're getting some data when all is said and done, it was very evenly split. So yes, you had the commentary on tariffs, but you also had commentary that, regional economies were looking more resilient. I think at the end of the day, the issue here is that consumers are continuing to see wages come in, wages grow at a reasonable clip, wages grow, importantly, back to the Fed conversation at a level and a rate that's consistent with a 2% inflation target. To me, the risk isn't really around tariffs. To me, the big risk is that the Fed does too much too quickly, you end up seeing the labor market tighten at the beginning of next year as consumer demand comes back, and that puts the market in a tricky spot given what's being priced in terms of Fed easing in 2026.
What do you mean by too much too quickly?
I think that while 1 to 2 cuts between now and the end of the year is a reasonable expectation, when I look at what markets are pricing, kind of the 1 per quarter over all 4 quarters next year, to me 6 cuts from where we are is just the economy doesn't need that. And productivity has been helping out. Given the revisions to payrolls, we saw in 2024, there were months of negative payroll growth, yet economic activity was 3%. That means productivity is beginning to show up.
I get the feeling from speaking to people, David, that they are pricing 2 different Feds. The Federal Reserve from now until May, and a Federal Reserve that might change after May. May or may not change, depending on what the leadership looks like. Do you get that sense as well?
I think at the end of the day, one of the things that keeps investors coming to the United States is that rule of law and that structure, particularly on the financial side of the equation. And so, by my lights, will there be a change in Fed chair? Absolutely. I mean, that's been very well telegraphed. But do we need to worry about the tails of that distribution? To me, that's less of a concern. I think when all is said and done, you get somebody that is pretty much down the middle, because putting in too radical of a candidate, I think, would undermine confidence in the U.S. markets and therefore the U.S. economy.
And certainly based on inflation-based expectations, market-based inflation expectations, we haven't seen them break out in a material fashion.
Exactly. What the Fed's worried about at the end of the day is that reacceleration in wage growth. There isn't a really strong relationship between manufacturing goods prices and manufacturing wages, but there is a strong relationship on the services side. And so for people that are worried about the tariff impact, that's where I would focus, because that's where you could see that feedback loop materialize, putting the Fed in a trickier spot.
Where we have seen a breakout, though, is outside of fixed income. We've seen it in gold. Stocks have broken out, they've rallied hard. Gold has too. Is that a different trade, a different signal, or the same trade?
So I think it's 2 shades of gray, if you will. I think that the equity trade is really driven by expectations for robust profitability and an environment with a little bit more inflation, where because stocks are nominal assets, they should be able to handle that fairly well. We've seen that over the past couple of years. The gold trade is worried about debasement, but also that inflation. And so inflation is the common variable between the two, but focusing on very different things. One trying to preserve your purchasing power, the other trying to benefit from better nominal activity.
So we had a guest on the program yesterday who was talking about where the speculative fervor might be. A lot of people pointed to AI and a stock market bubble. And he pointed to, I'm talking about Alex Altman over at Barclays, he pointed over to gold. And essentially what he was getting at, and I got some comments on the Bloomberg terminal at the same time that conversation was happening, is we've got to think about why a non-yielding asset has rallied 60% and outperformed stocks in a bull market. Where's the speculation? Where's the froth here? How are you thinking about that?
So to me, it's bad speculation, right? People are speculating because they're worried about all of these things that are happening around the world. In our long-term capital market assumptions last year, and in the edition that'll be released this coming Monday, 2 of the themes that we focus on are these ideas of fiscal activism and economic nationalism. And when you think about the impact of those, right, it generates more inflation, but it also generates more investment. And I think people are just worried about this new equilibrium that's being established, where governments are looking inward, governments are spending more than they did in the post-GFC environment, and frankly, inflation is above where central bankers would like it to be. That's a very different setup from where we were for the 10 years after the financial crisis.
But do you think it signals de-dollarization?
I don't. I think at the end of the day, the dollar is the world's reserve currency. I think that the volume of transactions that occur in dollars make it very difficult for another currency to take its place overnight. And I think some of the interesting conversations that we've all been having about the development and growth of the stablecoin market could potentially even reinforce that, because the underlying assets there are things like treasuries, money market funds, so on and so forth. When you look at what's happening in emerging markets, it's much easier to move stablecoins around, get around capital controls, than it is to move physical currency. So some of these trends may actually reinforce the dollar's role as a reserve currency, which is certainly a contrarian.
Have you got a tease for us for the LTCM assumptions?
So what I would say is that we are more excited than you are worried. This is one of those environments where clearly the market is not the economy, but there's more to come on that on Monday with some of my colleagues.
I'm not going to ruin that. I won't go there. David, thank you, sir. Appreciate it. Thank you very much. David Lebovitz there of JP Morgan Asset Management, more excited than you are worried. Let's get you an update. I like that. On stories worldwide with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. A federal judge has ordered the Trump administration to pause plans to fire thousands of federal workers during the government shutdown. The order isn't a final decision on the merits of the case, but temporarily prohibits over 30 federal agencies from sending out layoff notices. Some 4,000 notices had already been sent out since last week. Elsewhere, TSMC shares rising after hiking its 2025 revenue projection for the second time this year. Boosted by AI chip demand, the chipmaker's third quarter revenue beat expectations. TSMC's CEO noting geopolitical uncertainty is weighing on the sector and that large swathes of China are closed thanks to US tariffs. And United Airlines reporting resilient demand fueled by its premium passenger class. The airline expects its brand-loyal flyers to continue to drive profits. However, operating revenue for its third quarter fell just shy of street expectations, pulling shares lower in pre-market trading. The CEO, Scott Kirby, will join us at 8:15 a.m. Eastern. And that's Bloomberg Brief. John?
Looking forward to that, Lizzie. Thank you. Scott catching up with Lisa. Lisa's down in Washington. You'll hear more from her in about an hour from now. Up next on the programme, cockroaches on Wall Street.
I guess he's saying there might be a lot more cockroaches at JP Morgan. It's not a private credit issue. There will always be bankruptcies.
Dave is just really happy we didn't ask him about that. We'll ask Alberto Gallo instead of Andromeda Capital Management. He joins us next from New York City this morning. Good morning. Equity futures this morning positive by 0.4% on the S&P 500. The main event about 15 minutes from now. We'll catch up with the man himself, Governor Chris Waller of the Federal Reserve at 7:30 Eastern Time, live right here in the studio here in New York City. The data blackout, if we can call it that, continues ahead of the Fed blackout that starts later this weekend.
Yeah, it's a data desert. We don't have official government data. So I'm also interested to hear from Governor Waller what he is relying on in this moment, because the Fed needs to also make an excuse as to why they're cutting interest rates. Maybe they do see a weakening labor market. We know that from September. We know that from the previous labor markets report. But if they are data dependent, we don't have the latest updates, and we might have hot CPI. It'll be interesting to see what he's exactly seeing right now in the labor market and what secondary tier data he's looking at.
In the data elsewhere, we'll get to that in about 15 minutes' time. Look out for that conversation. Equity futures on the S&P then advancing potentially for a second day, higher by 0.4% on the S&P 500, on the Nasdaq by 0.6%. I say potentially for a second day because the last 4 days have all been about one thing. It's not been about the earnings. They've been okay. It's not been about Fed policy. Doors still open for a rate cut. Almost exclusively, it's been about the tension between the US and China.
It's why I have alerts on for the Chinese Commerce Ministry the second they come out and say something. Or President Donald Trump's Truth Social post. Is he going to come out and potentially talk again about the fact, yes, we are in a trade war, we know that, but he made it very clear yesterday, talking about 100% tariffs potentially on China. When will we get any sort of clarity? It might not be till the end of the month. So every single day, we could see potential for a whipsaw in financial markets.
The Treasury Secretary, Scott Bessent, saying the leadership talks are a go. So it's still on for talks between Xi Jinping and President Donald Trump. Under surveillance this morning, a focus on one thing, cockroaches on Wall Street.
Jamie Dimon at JP Morgan, worth mentioning what he said on their earnings call. He said, my antenna goes up when things like that happen. When you see one cockroach, there's more. Everybody should be forewarned at this point. What do you make of his warning?
So I guess he's saying there might be a lot more cockroaches at JP Morgan, or I'm not sure I know what he's saying. I mean, it's not a private credit issue. I mean, it's a liquid credit market. There will always be bankruptcies. There are thousands of credits in the marketplace.
So here's the latest this morning. The JP Morgan boss, Jamie Dimon's cockroach comment, reviving fears about the health of the credit market. Alberto Gallo, the CIO of Andromeda Capital Management, writing the following. First Brands and Tricolor are a warning sign. We believe there's a turn in the credit cycle. Alberto joins us now for more. Alberto, good morning.
Good morning.
Welcome to New York. It's been too long, my friend. A warning sign, a turn in the credit marketplace. Whereabouts? Where do you think the so-called cockroaches are right now?
So we're at a 30-year tide in credit spreads, and this has been fueled by monetary liquidity and fiscal spending. The problem is investors have been used to this environment of low volatility because governments are spending a lot, and they're spending a lot for geopolitical reasons, and the Fed is cutting with inflation way above target. So the volatility, the price discovery in the market is being suppressed for a very long time, and investors have misallocated capital to vehicles that don't have mark-to-market. Now, why would you lend to a company that has something to hide, that is funding from a fund that doesn't have mark-to-market? There's a lot of conflict of interest around that area, that of the private credit world. 80% of LBOs, for example, are funded by private credit funds right now. So we've seen this developing in the last 2-3 years. Right now, when spreads are really tight, we're in an elongated cycle. We have the Fed deploying record stimulus, cutting to a very low neutral rate. Why would you invest in those areas of the credit market? There's other ways to hedge from debasement. There's other ways from hedge from a declining dollar, if you're worried about that, or to chase the AI returns. But credit is not the place to do it. So you've got to be really cautious now and avoid those weak credits. Where are they? Well, they're in the private credit market, in low-rated credit, in companies that rely on low rates to survive, companies that have done very little restructuring, for example, only a 5 or 10% haircut, amend and extends. There's a lot of those names, and we have avoided them over the past few years.
It sounds like you don't think that these two names, First Brands and Tricolor, are idiosyncratic. Are you expecting more of the same thing?
Typically, when we have seen firms, we've seen a lot of firms that cannot fund in the public market going into private markets. When we have seen that, we've seen like signs of adverse selection. So yeah, we have seen many examples of firms that have very complex capital structures. They have opaque governance. They're in private hands. They don't have disclosure, and they have most of their funding in private markets. So definitely, we have done a lot of work. We have those firms on the radar. Some of them we are short. And we believe there's going to be more pain in the coming quarters in those areas of the credit market. It's not inconsistent with equity markets going up. You can have Fed liquidity pushing the dollar down, gold up, S&P up, and at the same time, these firms going down. Fed liquidity is not going to save the next First Brands.
Do you think there's a channel for contagion risk that we should be considering? And what is that channel?
The channel is, there's different parties that have been in the ecosystem of private credit and generally these exuberance in credit markets. The behavior reminds me a little bit of what was happening in 2006, 2007. So you have the arrangers, you have the funds, and you have obviously the companies. Not everything is tradable. You definitely now want to avoid those areas. Again, credit spreads are really tight. You want to be capturing opportunities in credit. If you're locking your capital for 5 years and there is a crisis or dislocation, you can't capture that. The current valuation premium between private and public is just 1% to 2%. And if you adjust for quality, that's really very little. So you're not really getting paid and you're locking your capital. You lose optionality.
You keep referring to credit spreads. Now, IG credit spreads are near multi-decade tights. I believe that's what you're referring to. You're seeing tight spreads across the board as you go down quality, go down to high yield. Are you seeing the same thing?
There's been a widening in the worst bucket in the triple C names, which is symptomatic of some of these low-quality credit being avoided by investors. So, after these two large-scale bankruptcies, obviously, risk managers are patting on the back of portfolio managers, and they are going through all the exposures. So there's been a widening. But, overall, credit spreads are still at a 30-year tight or a multi-decade tight. And in the U.S. market, we are at a 15-year record long positioning in credit. So what is happening in the world is investors have been buying risk assets for capital preservation. They've been buying risk assets because they believe inflation is above target, and I'm sure you'll talk more about this, and will stay above target. But this has created some misallocation of capital. Investors have been, targeting these all-in yields to try to beat inflation, but in the process, they've been lending to firms that are doing, not very good things with that capital.
Just hang on a minute, Alberto. When you say investors are allocated for capital preservation, typically that's something I'd expect to see in something like gold. I'm seeing that.
Exactly.
Are you saying the same thing's happening in equities?
Yes, because essentially the top firms in the S&P are monopolies. So if you're thinking about going to a regime where the dollar is very stable, to a regime where there's a multipolar currency world, and governments continue to print money. There's various ways you can get out of too much public debt. That's the problem we're talking about. The West has too much public debt, not enough productivity, and demographics are not great either. It's a bigger problem in the UK and France, but it's also a problem in the US. So what do? You try to grow out of your problem, but it takes a long time. You can't restructure. You can't do austerity because it's very politically difficult in an environment where inequality is record high. Millennials have only 15% of wealth, and they're the median voter now. So you try to make other people pay. The Trump administration is trying to do that. Or you print. And the reason why investors are worried about this is the administration is toying with a lot of monetary experiments, stable coins, 100-year bonds, bank deregulation, in the UK, reducing the reserves interest rate that the Bank of England pays to banks. So a lot of easing measures, and also ending quantitative tightening, doing quantitative easing again, discussions of yield curve control. So if you think about this is financial repression. It means keeping interest rates below inflation. Government bonds are clearly, overvalued here, but credit is the second most overvalued asset because it's been extremely stable for that reason. And I think that we're not going to escape that world. But the reason why gold is going up, the reason why the Mag 7 are going up, and the reason why credit spreads are very tight is the same, is high government spending and central banks accompanying that spending with easing.
But aren't the Mag 7 going up because these companies are talking about basically a revolution in how we live in society and the CapEx boom they're going towards them, while gold is really just a place to hide? You think Mag 7 is also a place to hide?
We think it's the same trade. Right now, think about Microsoft. Think about Windows. You could imagine a world where we have another operating system that's maybe a little bit better. Probably humanity would have gone to Mars already. But Microsoft is a monopoly, and we have to buy Windows every 2-3 years, right? Do you see a lot of is Windows 2030 going to be, much better than the current one? Maybe, but a lot of the capital flows in these companies are also, in part, obviously they bet on future innovation, but in part they are a way to preserve capital because of the monopolistic nature of these firms. So if you have a situation where tomorrow, I'm sure you've seen the New York Fed paper on gold revaluation from August. If tomorrow the US Treasury Secretary decides to revalue gold and passes the profits from the Fed to the Treasury and decides to spend more because debt to GDP looks lower, then what happens? You'll have a dollar down, S&P up, and gold up trade. So that's what investors are worried about. So what do you buy? Do you buy art? Do you buy the Mag 7? Do you buy gold? They are essentially, at the extreme, they are the same trade.
Alberto, it's good to see you, sir. Thanks for being here. Alberto Gallo of Andromeda Capital Management. How many times have you asked Secretary Bessent that very question?
A ton of times, because right now on our balance sheet, it's a little over $42. That's what gold is. And ahead of the midterm elections, could you not see this president remarking it?
Yeah, gold's north of 4,200 at the moment. Up next on the programme, Fed Governor Christopher Waller, a front-runner on the shortlist to replace Chairman Powell. We'll talk to him about this economy, the impact of AI, and what it means for the next decision at the Federal Reserve and beyond. From New York City, you're watching Bloomberg TV. Stocks are positive, some positive follow-through from yesterday. Equity futures higher by 0.5% on the S&P 500. On the Nasdaq 100 so far this morning. After a really volatile 4 sessions, we're higher by 0.6% as we count you down to the opening bell 2 hours away. With your morning movers, here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Well, TSMC casting a nice halo over this market today. That's one of the reasons we saw futures higher this morning, because it raised its outlook for the second time this year. It now sees revenue growth in the mid 30%. Although I have to say, the CEO, C.C. Wei, did reiterate that the industry is grappling with geostrategic and geopolitical uncertainty, and also talked about those U.S. sanctions and that how they've begun to close off swaths of China, which is still the biggest chip market. So we're seeing shares up more than 2% of the pre-market. Important to note, though, ADRs trade at a significant premium to shares listed in Taiwan, and ADRs are up 127% already since Liberation Day. Let's move to AEP. It is moving just very slightly in the pre-market. News just out a few moments ago that the Trump administration has finalized that $1.6 billion in financing for one of its subsidiaries. So you'll get 5,000 miles of upgraded utility transmission lines across Oklahoma, West Virginia, Indiana, Montana, Ohio. So this financing is just one of many to come. It's part of $23 billion in conditional loan guarantees started under the previous administration. And finally, remember when we were talking about lithium all the time? Well, JP Morgan, the latest to downgrade Lithium Americas, although it has still had a 200% gain so far this year. Apparently, analysts have been souring on this name because the deal that was done with the government for 5% equity and a 5% stake in the Thacker Pass mining project, well, it's not quite as good for shareholders. So that stock down. It's still, though, trading at a 40% premium to the average analyst price target.
What a rally. I think it's fair to say a lot of analysts missed that. Vonnie, thank you. Vonnie Quinn there with some of the movers. Just a programming note, in about an hour from now, the Energy Secretary Chris Wright joining Bloomberg Surveillance first to respond to that story. Turning to the Federal Reserve, the list of candidates to replace Chairman Jay Powell reportedly down to the final 5. The list emerging following extensive interviews with the Treasury Secretary Scott Bessent. On that list, Fed Governor Chris Waller, who joins us now. Governor Waller, good morning.
Well, good morning, John, and good morning, Annmarie.
Welcome back, sir. It's good to see you. How's the process going? Let's start there, and then we can get into all the other good stuff. How's the interview process going?
It's going well. As far as I can tell, the Secretary has a very systematic way of going down the list and doing the interviews. As I said the other week, I had a great interview with Secretary Bessent. Talked a lot about economics, Fed policy, the Fed, balance sheet, just general stuff in the economy and financial markets. It went very quick. It was about an hour and 45 minutes. The next thing I knew, it was over. So it was a great conversation. Of course, I love those kind of conversations. I can do that all day long.
The Treasury Secretary spoken about in the past, he wants almost a visionary, someone who looks forward, like an Alan Greenspan type, open-minded. Do you get a sense of what he means by that?
I think it's the idea of if you're looking at the data and it's always looking back at the data, the data is always kind of old and you have to think forward, like where are you going with this stuff? I've managed to do that a couple of times with thinking about this beverage curve argument back in May of 22, that we could have the soft landing earlier this summer with the weakness in the labor market, which turned out to be true. People doubted it at the time I said it, but so I think I don't want to, brag, but it's that kind of being able to look at the data and see forward where things are going, and I think that's a critical thing he's looking for.
You were certainly vindicated. The president was obviously excited about the fact the Fed finally was cutting interest rates. Have you spoken to him at all?
No, I have not.
Is that on the schedule?
I don't know. That's up to Secretary Bessent.
We're going to find out soon, hopefully. We'll talk to the man himself, the Treasury Secretary, hopefully later on in a month. I want to talk about the meeting that takes place at the end of this month as well. You were pretty clear going into the last meeting. You delivered a speech, and I believe the title was "Let's Get On With It." Yep. Are you advocating for the same thing at this meeting?
Yeah, I think it's the right thing to do. Back then, there was an issue of whether you go 50 or 25, and I argued we could do 25 and see how the data comes in. Of course, we're not getting much data, and then we can think about the next 25. So in the last 6 weeks, I don't think a lot has changed. We're not getting the public data, but all the private sector data that we're getting, Beige Book yesterday, everything we're getting is telling roughly the same story. The labor market's weak. Growth seems to be on the stronger side, which is a bit of a puzzle right now because you can't have a really strong growing economy and negative job growth. There's zero job growth. And people talk about productivity, but AI hasn't had that effect yet on the labor market or productivity. It will down the road, I think, but not right away. So I don't think that's the story that's driving it. So in that case, one of these things has to move, right? Either GDP numbers start coming back down or the labor market rebounds. You just can't have growing economy and very weak labor market. They just don't go together.
In the meantime, do you just continue to reduce interest rates meeting by meeting as you wait to see what's going on? What's your overall approach and how you think about that?
That's exactly what I've been arguing. Is since we don't know which way this is going to break, if the labor market rebounds, there's less of pressure for cutting rates. If the growth comes back down, there's more pressure for cutting rates. You don't want to make a mistake. So the way to avoid that is to go, cautiously or carefully and do 25, wait and see what happens, and then you can get a better idea of what to do. But if you've already started the process, you're providing whatever initial support for the labor market that you feel is necessary.
So we've had this obvious step down in payrolls growth. It's pretty clear. Yeah. It feels like that alone, though, might be an outlier compared to everything else that's going on in the economy. You yourself just acknowledged that. What do you think is behind that? And can that persist?
That's the thing. When I've talked to private sector CEOs about hiring, we typically get a couple things. Maybe early part of the summer, there was a lot of uncertainty about tariffs. We're just holding off on doing anything. One of the things I heard is firms were going to have to pay the tariffs. One easy way to do that is just not hire. take all the labor savings to pay off whatever the tariffs were. So that was one thing. Then you had this AI story, which was people like, we don't know if we're going to need to hire, but we're going to wait and find out. We're not going to go out and hire a lot of people right away. So I think the tariff uncertainty, paying for tariffs, trying to sort out what AI really is going to do, kind of put firms on their back foot. Now, that's what I mean. Either they decide the AI is not going to be in the near term the big job replacement that they thought, and they're going to have to start hiring, and it comes back, tariff uncertainty goes down. All of those things could lead to a rebound. On the other hand, if GDP starts softening, it's not as strong as we think, that somehow the data is a kind of a mirage right now. Then the labor market is telling you things are just not as good as you think. Now, the financial markets are the big puzzle. I mean, I'm not the only one. How much of this is just a big boom in AI and everything else is marginal? I've kind of been arguing there's a big difference between the financial conditions for corporate America and financial conditions for Main Street America. If you're Main Street America, you're looking at mortgages over 6%, very expensive housing, car loans over 7%, credit card interest rates in the 20s. These are not loose financial conditions for American households. So when we look at the financial markets, you're seeing a lot of when people talk about credit spreads and all that. I don't think most American households care what the credit spread between corporates and treasuries are. That doesn't really, unless it shows up in mortgages. So I think there's this is one of the things that I find kind of puzzling right now, is there's just always these dichotomies between things. If you look at AI, if you take out anything data center AI related, business fixed investment is turning down. It's not widespread. All this investment is not widespread across. There's a real reallocation from kind of everything else into AI. So there's this bifurcation in so many ways that make kind of reading the economy tough right now.
How much influence do you have on one versus the other? Financial conditions on Main Street versus Wall Street. Wall Street's immediate. Wall Street's gone. It's off to the races. Yeah. Can you really influence financial conditions on Main Street?
Well, that's kind of what we hope. If you think about cutting rates, which we're doing and I think we'll continue doing, that does have a pass-through to the 10-year. And the 10-year is often the anchor for pricing mortgages. So the 10-year is down to like 4%. It's come down from 4.5%. That's about 0.5% off. If it were to continue drifting below 4%, you'll start seeing some downward pressure for certainly mortgages. Auto loans are kind of a different thing. They're trying to figure out how to deal with tariffs on the auto industry. One thing I've heard is they got rid of a lot of cheap financing that they used to subsidize for consumers. That's going to raise the cost of financing. All these things are more tightening for Main Street America. So hopefully these things, as we go on through the rest of the year, start loosening up some.
You've been watching the programme, so you know some of the things that people say on the show. I'll just go over it briefly. Ultimately, equities at all-time highs. Gold's ripped 60% this year. You mentioned credit spreads.
Yep.
IG credit spreads are multi-decade tights. High-yield spreads near the tights of the year. And there's a theory out there that the Federal Reserve and some officials on the Fed, perhaps yourself included, have anchored their view of this economy around the step down in payrolls growth and are going to be lulled into reducing interest rates when maybe they shouldn't. And all that's going to do is fuel financial market excess. Just to give you the chance to respond to that, how would you respond to that? This idea that you run the risk of being lulled into reducing rates when maybe you shouldn't.
Well, the mandate I have from Congress is maximum employment and stable prices. It's not the financial markets. So I look at, that's why when I'm looking at the labor market. The labor market is weak. If all these loose financial conditions are going to cause a boom in excess in the U.S., we should start seeing some of that in the labor market. We're not seeing it. So a lot of this is, I think, just this is where the AI thing is. There's so much speculation on AI that it's kind of, again, this dichotomy. It's kind of overshadowing everything else that's going on. And like I said, my job is unemployment and price stability. And I think inflation will be okay. It's on up, but some of the tariff effects will come back off. But my job is about the labor market, and it's not good. So if you want me to go to Congress and say, hey, tell me to start worrying about financial conditions, and that's how I should set policy, let me know. But until they do that, I'm going to keep focusing on
let's go with the dual mandate, and let's stay with AI. And the potential that introduces some additional tension into the dual mandate, that it holds back employment, but also boosts prices. Annmarie was talking about what it could do to energy, all the spending, resource intensive. We had a guest on the programme talking about the same thing. Would you see that as a potential that it introduces some additional risk into the dual mandate?
Well, in terms of inflation, I mean, one of the things, I was asked this question by some people in the AI sector. It was like, isn't this inflationary, all this spending we're doing? I said, yeah, but you're taking it away from other sectors. So those other sectors are seeing less demand. So this is, in my view, a lot of this is a sectoral reallocation. And if that's the case, then the increase in AI is going to be offset by other things. Now, true, energy may have a bump up, but then you just look at core, because you kind of knock out the energy part of it. And that's really what you want to do. That's why we kind of knock off energy. It's just so volatile, it gives you the wrong signals.
So, Governor,
when we look forward, when we're just looking forward.
What I hear from you is you can look through tariff-induced inflation, you can look at AI-induced inflation. Is there any inflation out there right now that you see that you are concerned about? Because we're potentially going to get a pretty hot CPI print at the end of this month.
Well, we'll see. When we take the data at the board and we have various ways we try to tease out the tariff effects, our estimate is inflation's running about 2.5%. And we're not seeing anything that's going to explode. Like I said, all this attention on AI is ignoring the fact that other stuff is softening. So demand is up in one sector, it's going down in another. Those things often, not completely, but often offset. So that's why I'm not really worried about the AI stuff. And if it really did cause some big problems in energy, like I said, just if you're thinking about future inflation, just look at core, don't bother with headline.
At the end of the month, though, you might not get the labor market report.
Right.
How difficult is it? And can you even provide outlook, meeting by meeting, in this environment?
Well, I have this joke that for those who think we're too data dependent, you're going to find out what non-data dependent policy looks like.
I'm excited.
But that's the point. We do have lots of data. Like I said, we've got lots of labor market indicators that tell us the same story. It's not good. We don't get a lot of other things as, oh, the labor market's great. So I think the data from all the sources is telling you the same story. The labor market's weak. We're getting this data, conflicting data about GDP. Like I said, the Beige Book came out. It was not like everything's rosy and booming. There could be still, in the GDP numbers, still a lot of inventory pull forward that because the China tariffs weren't finalized, so get them in, get stuff in now. So it may be that we see, GDP start to pull off at the end of the year. I think about the tax bill in that there was a lot of incentives for business fixed investment. That's great, but that applies equally to AI and non-AI. So at the end of the day, you're still deciding whether you want to go into AI investment or non-AI investment, and the AI is winning. So I don't know how much of it, how big of a help it's going to be on the non-AI kind of sectors in the economy.
You've called yourself a techno-optimist. Enjoyed the speech, by the way.
Oh, thanks.
Yesterday. Thank you for that. I just wanted to finish on this before you run. This feels different to last year. When you came out last year and you made a big step down in interest rates and cut by 100 basis points off the back of the employment scare through the summer, this feels slightly different in your approach. How would you describe the differences between now and the approach of you and what you're advocating for on the Federal Reserve to what the committee did last year?
Well, last year we didn't have all the tariff uncertainty. We didn't have this AI thing. Unemployment was not even remotely talked about. So I'd say those are the two big differences. Like I said, I think the tariff stuff will settle out and be okay. The AI thing is the concern I have with the AI, if it does, and I think it will materialize. Monetary policy is designed to deal with cyclical movements in the labor market, kind of ups and downs that come with the business cycle. But this feels like a structural change. All right, labor demand just drops and doesn't come back. That's something I can't do anything about. The Fed can't kind of adjust policy to deal with structural changes in the economy. So it's going to be a challenge to say, is anything we're seeing in the labor market from AI coming down the road, is that something the Fed can do anything about or should do anything about? Or are we just seeing kind of a typical cyclical movement where there's a hot sector and then it cools off later and everything's not quite as futuristic as you think it is? So that's, I think, for me, the biggest challenge looking forward is this a structural change or is this just a cyclical change?
Is the prudent thing to do as a risk manager just to assume it might be cyclical and cut just in case?
Yeah, I mean, if you cut and it ends up being structural, you cut. It's not going to undo whatever you did. But if it is cyclical, then you can help rebound and get the economy back on its feet, or the labor market back on its feet.
I think that's a good preview of what the conversation might be like around the table at the end of this month. Governor, I appreciate your time.
Thank you all. I appreciate being here again.
Thank you for being here, sir, and hopefully you come back soon.
Yep.
The Fed Governor, Christopher Waller, on the latest situation in the economy and what it means for policy for October and well beyond. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Donald Trump says that he might go to the Supreme Court to personally watch oral arguments on whether the bulk of his tariffs pass legal muster. The High Court will hear arguments next month over whether import taxes imposed by Trump are legal, with Trump saying that the tariffs are authorized under the 1977 International Emergency Economic Powers Act. Elsewhere, Israel has threatened to resume attacks on Gaza if Hamas does not follow through with all the steps outlined in President Donald Trump's peace plan. Israel's military has been ordered to prepare if the militant group does not disarm and return all the bodies of dead hostages. Hamas has so far released the remains of 7 hostages, leaving 21 unaccounted for. And the US and Canada are reportedly considering reviving the controversial Keystone XL pipeline as part of a bargain to ease some of President Donald Trump's tariffs on steel and aluminum. That's aluminium to you, John. The Financial Times reporting Canadian officials, including Trade Representative Dominic LeBlanc, have been discussing the plan in Washington this week. And that should be my brief. John.
Lizzie, thanks for that. Slowly pulled into Team Aluminum since I've been here. But anyway, up next on the programme, the race to replace Fed Chair Jay Powell. That conversation with Neil Dutta of Renmac. From New York, you're watching Bloomberg TV. Live from New York City. Welcome to the program. Equity futures on the S&P positive by 0.4% on the S&P 500. Under surveillance this morning, the race to replace Fed Chair Jay Powell.
I had a great interview with Secretary Bessent. Talked a lot about economics, Fed policy, the Fed, balance sheet, just general stuff in the economy and financial markets. It went very quick. It was about an hour and 45 minutes. The next thing I knew, it was over. So it was a great conversation.
Governor Chris Waller, absolutely fantastic, advocating for another interest rate reduction at the end of this month. The latest on the race, the Treasury Secretary Scott Bessent narrowing down the list of candidates to replace Fed Chair Jay Powell. According to reports, Bessent down to 5 names, including the man himself, Governor Chris Waller. Neil Dutta of Renmac, following the race closely, joins us now for more. Neil, good morning. Strong supporter of Governor Chris Waller. Tell us why.
Well, I think you just saw why. I mean, obviously, I agree with and sympathize with a lot of what he said, but I think what's important for someone in a position like that is the ability to persuade the people around you, right? I mean, it's a consensus-building institution, and I think he basically told you why he views things the way he does. And if you're trying to build support for looser monetary policy in that committee, that's the way to do it.
At the heart of his argument ultimately is an argument to disregard the inflation fear, that there's nothing to really worry about here. And ultimately, that's something that you share. Can you explain why? Break that down. Why is there nothing to worry about?
Well, I mean, I just find it fascinating that we're even talking about inflation with oil prices collapsing. I mean, call that a peace dividend if you want. Oil prices are falling. Labor markets are cooling. And we also know now that rental inflation is disinflating again. And you're there talking, I mean, people, some hawks are talking about inflation risk because of tariffs that haven't shown up as much as they thought in the first place. So it's a little bit ridiculous in my opinion. So that's why I am a strong advocate for interest rate cuts. But yeah, I mean, I think the risks to inflation are not really skewed to the upside.
But Neil, the tariff story is not done. We are on a truce right now when tariff levels between the U.S. and China went as high as 145%. The story's not over.
I mean, there's the effect. Remember, there's the effective tariff rate. There's what the announced tariff rate. There's the threat of tariff rates. But you have to focus on things as they are. And at the end of the day, if you told someone that the effective tariff rate would be, I don't know, like 12%, whatever it might be at the moment, and that core inflation would be where it is, I don't think most people would have believed that. Most people would have expected it to be higher. So what does that tell you? It tells you that underlying inflation was in fact cooler than you thought going into all this. Again, which is supportive of the idea that you should be bringing interest rates down. At the same time, it's really about the nominal anchor, right? Like the fact that the labor markets are cooling, it just, to me, suggests that consumers don't really have the ability to absorb higher prices. So if a company tries it, what are they going to do? they'll raise prices. People will be forced to allocate more of their household budgets towards that item, and then they'll have to cut back elsewhere, driving down the prices for those things. So that's, to me, a lot of this is just an identity. I mean, whatever doesn't go into P will come out of Q. And so, the fact that nominal incomes are slowing, limits the upside to inflation, in my opinion.
You mentioned lower oil prices, but what we're seeing with AI is driving up electricity prices.
Natural gas prices have been moderate. But again, look at household inflation expectations. Look at firm inflation expectations. The Atlanta Fed, for example, still producing data because, and the business inflation expectations series is benign. There's no evidence that inflation expectations among businesses have been exploding, and that's important because those are the price setters in the economy.
So, Neil, how would you explain at the moment? Because I think a lot of people are focused on it. Is it cyclical? Is it structural? And if we've seen a massive step down because of payrolls dropping off the back of cyclical concerns, why aren't we seeing an increase in slack? That's the tension, I think, at the moment. Why are we not seeing unemployment climb?
We are seeing unemployment
in response to a massive step down in payrolls, a proportional increase in unemployment.
Well, there's probably some supply-side factors to think about, but again, at the end of the day, had the data been released for September, if the Chicago Fed is right, you would have been talking about 3 consecutive months where the unemployment rate rose 1/10, right? So I just keep coming back to this point. We had strong growth 2 years ago, and the unemployment rate rose 0.3%. We had decent growth last year, and the unemployment rate rose 0.3%. And you look at what's happening so far this year, it's likely to be up another 0.3%. And we know that labor demand is cooling. Governor Waller talked about the beverage curve. You're operating up on a point along that curve that's where the trade-offs are less favorable. So if you have further declines in labor demand from here, there's a risk of more outsized increases in the unemployment rate. And then look, I do think that we're kind of on thin ice here, right? Because most of the increase in the unemployment rate is really just about job finding difficulty. If you start to see layoffs pick up even a little bit because the hiring rate is so low, again, that'll lead to outsized increases in the unemployment rate. The risk is always, to me, it's always nonlinear, right? The risk with unemployment is always nonlinear in nature, and inflation, frankly, does not move in a nonlinear direction.
Why take that risk is essentially the argument that Governor Waller made 15 minutes ago. Neil, you've been very consistent on the matter. It's good to see you, sir. Thanks for being in studio. I don't think he came to see us, did he?
He came in studio clearly because he saw that Governor Waller was coming.
Can we talk about Gucci right here?
I work for you.
If it's a
we
top,
calling out a close today?
If it's a top, John, this is the outfit that did it.
Please.
We still think we're in a bull market.
We've got to accept the fact that we're in a narrative-driven market.
We do wonder if we're starting to get the peak levels of sentiment.
We've got price-earnings ratios which are close to the dot-com bubble peaks.
There probably should be some kind of a pullback. My guess is it'll be lighter than you think.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Another day of gains, potentially. Up by 0.4% on the S&P 500, up by 0.6% on the NASDAQ. Busy morning already here in the studio. Caught up with Governor Waller of the Federal Reserve 20 minutes ago, making a case for another interest rate reduction at the end of this month.
And he said the one puzzle, of course, is what's going on in the financial markets. But that's not his job. He made it very clear. His job is what is going on with the labor market and inflation. And right now, he continuously sees labor market weakness. He said it's not good, and it doesn't even matter to him that we don't have the recent labor market job report. He doesn't care if he doesn't have it. He's looking at everything else. He said the direction of travel is pretty clear.
At the midpoint for October, we're set up for a really interesting back half. 2 weeks away, we're going to get tech earnings. Going into month end, a meeting between Xi and Trump, and then this meeting for the Federal Reserve sandwiched in between. That's quite an end to the month of October.
And the Federal Reserve may be cutting into a scenario where that meeting could blow up. I don't think it's going to. I think the Treasury Secretary was trying to smooth the market and explain we're going to go for a longer-term truce. But the rhetoric is going to be really, really hot. And mistakes could be made in these moments. So you might have, at the end of this month, higher levels of tariffs when it comes to China, the two most important economies in the world, potentially having a more hostile behavior towards each other, and the Federal Reserve cutting in interest rates, they're worried about the labor market, even though hawks are still concerned on this committee about inflation.
We've got an interesting 2 weeks coming up. Next Friday, a week tomorrow, we will get that delayed inflation report, CPI, October 24th. If you're just joining us, welcome to the programme. Equities near session highs, up by 0.4% on the S&P. A big 60 minutes coming up. We'll catch up with Michael Roberts of HSBC Bank as stocks are edging higher. United Airlines CEO Scott Kirby on the back of his latest earnings report. And the US Secretary of Energy, Chris Wright, as national power costs are on the rise. We begin this hour with stocks rallying as traders shift attention from the US-China trade war to the start of earnings season. Lisa standing by with a special guest. Hey, Lisa.
Hey, John. Yeah, thanks so much. And Annmarie was talking about China and the U.S., and there's no one better to talk to than Michael Roberts, CEO of HSBC Bank and CEO of the Corporate and Institutional Bank at the region. I'm just curious, given the fact that HSBC, and welcome, is such a central bank in both trade as well as in both China and in the West.
Right.
How significant do you see this latest eruption of trade tensions between the U.S. and China? Does this feel different?
Yeah, no, first of all, thank you for having me today. Look, I think the world has gotten used to a lot of these tariff changes, although certainly this newest round is yet another bit of unpredictability. I think companies have been now looking for different ways to manage their supply chains. We have a survey that we did right after Liberation Day, which I think still holds true today. We surveyed 5,000 clients, so big survey, and they all said, one, all of these tariffs are going to cause a lot of issues. Prices will go up. Two, most of them now are looking at their supply chains. And the word, I think, supply chain has now come to be one of the probably the most discussed terms in any C-suite today. And thirdly, they're going to change, and they may even change business models. So this next round, this current round, I think just tells you that they're going to have to significantly change what that is, because 100% tariffs, you can't absorb 100% tariffs. So that means there'll be a greater acceleration to where those new supply chains will be. However, it has been a bit of a whack-a-mole because you have to constantly look at where the next tariffs will come from. And that's been a challenge for many companies. They really have to figure out what is the least vulnerable place they can be or the most tariff-proof place they can be, and how do they then export into the U.S. or, frankly, anywhere to make sure that they can do so as effectively as possible.
How much of the extra costs from tariffs been realized? And not just tariffs, but also the rejiggering of supply chains.
Yeah, so rule of thumb, when I've talked to most people, probably 70-80% is borne by the producer versus the importer. The last 20% now is starting to seep into end buyer, the customer. I think most are saying we can't continue to absorb that much additional costs as the importer or the distributor. Therefore, it will start shifting more and more to the end buyer, the client or the customer. So that there's been I think a strong effort, however, to try to absorb as much as possible. So I talked to a retailer, a high fashion retailer, saying, me and the distributor or the producer out of Asia and me as the distributor are absorbing as much as we possibly can. We understand we could do that, but it will come to an end soon.
John and Annmarie were talking to Fed Governor Chris Waller and about the balance between inflation and the labor market. And there's this feeling that any kind of inflation is going to be short-lived and the effect on the labor market could potentially be pernicious. Are you seeing that companies, instead of raising prices, laying off workers or trying to revert to artificial intelligence to bridge the gaps?
Not yet. However, there is a lot of cost pressures. I think there's a delay, a lot of investment. I mean, that's the flip side of that, because I do think people want predictability. Companies need to understand where they're going to put down a lot of capital, that capital is going to produce good returns because more predictability. I've seen slowing of hiring, but not real firing today. And so that's kind of, again, the flip side of that coin. But really, it's the capital and the investments that you're starting to see slow down quite a lot.
Meanwhile, we've heard a lot here at the meetings in Washington, D.C. about a number of themes, AI, which we'll get to in a second, but also this question around credit froth and an AI-related bubble. How much are you getting concerned, akin to what J.P. Morgan's been talking about, of a real turn in the credit cycle or some sort of later innings that give you pause and make you more cautious?
Yeah, look, I do think this is not the first instance of what is inventory financing fraud, which is essentially selling, or using the same bit of inventory to finance multiple times. We've seen that in Europe a couple times as well in the last, say, 9 months. So I am more concerned, and something that we're very focused on. So, in fact, we're using technology we developed in our trade business and using that throughout all of our lending platforms now to try to go through and be very specific that everything we finance is good collateral. It doesn't have multiple liens on top of it, which is really what happened at First Brands. It's tough to do. And I think, the fraudsters are getting better at it. So we're going to have to respond to being much better on due diligence. We were not involved, obviously, directly in First Brands, so don't know how much due diligence was done, but I think these type of financing arrangements are going to require much more due diligence, much greater technology, much more specific understanding of exactly what you're financing.
The other aspect has been just sort of how much AI has actually boosted productivity, boosted profitability versus been a real cost center for the most part. Ken Griffin came out of Citadel saying that he's not seeing evidence that AI programs can really make an edge in financial markets. I know that HSBC has been big in quantum computing and has this test. Are you seeing real gains? Are you actually deploying quantitative strategies from quantitative computing on your trading floors?
Yeah, so just for those who don't know, we had a partnership, still do, with IBM. We developed quantum computing really for financial markets, focusing on the bond market. And we use both quantum computing and more traditional computing, brought them together, changed the way we looked at data. There's this thing called representation data that we actually flipped into a more of a quantum computing type of mode. That led to a 34% improvement in our ability to predict a trade. So if you were going to make a trade, we get to understand that trade 34% better to see the matching between buyer and seller is really what it comes down to. So that was very effective. It's an initial study. We did, however, test it on multiple quantum computing machines. We did all the statistical analysis. So we really do think there's something there. It can be used for any traded asset, so any asset class. I think the power that brings is going to give an edge. I don't know how it wouldn't give an edge, but I think it'll be, once we roll it out and others roll it out, there'll be quick adoption by, I think, the industry. I mean, it's the same industry that tries to reduce latency to its, smallest possible amount. So I do think technology does bring a substantial edge.
Do you think it's going to replace traders?
That I don't know. I mean, I think there'll always be humans involved, but I think it'll help traders quite a lot. And I think it'll change really the way traders think about it, because when you have that much compute power and you could really use it, I think today, we use a lot AI, as you said, through algorithmic trading. This will just be one more substantial boost to the power of algorithmic trading that we see today. So will there be less traders? Don't know, but are they going to have powerful machines? Definitely so.
The other theme here, and this is something that comes up in pretty much every conversation, is the debasement of the dollar. Yeah. And this question of how much the dollar is losing its heft as a reserve currency. Yeah. Internationally, do you see any signs that people truly are moving away from the greenback? Yeah, it's a great question. So I happen to be traveling to Asia right after Liberation Day, and I would say that was probably the number one conversation that I was having by very big, very sophisticated, large holders of dollars. And they were quite focused on this idea of de-dollarization or debasement of the dollar as a reserve currency. And the mere fact that they're talking about it in the terms they were tells you something is different. Now, if you look at where the dollar is today, trade flows, reserves, the primary currency of invoicing for most commercial flows, the markets flows, it's all well north of 50%. It's 60, 70, 80% in all those various metrics. It will take a long time to find another reserve currency. And the other biggest question is, if you're going to go away from dollars, what are you going to do? And what will be that reserve currency that replaces it? There is no other alternative today. And so that's the twin issues that you have, the conundrum. Maybe go away from dollars, but what are we going to go to instead? To wrap it all up, there is this feeling that the center of finance has shifted. Mm-hmm. And it's not so clearly in the United States. And it's something that you've been focusing a lot. How do you see the sort of tentacles of finance in terms of where they are flowing from, transforming really over the past couple of years? Yeah, no, I think there's significant transformation going on. And if you think there was a unipolar world with the U.S. right in the middle of it, still is. And, the U.S. capital markets, the most liquid of the world, still the dominant place to trade. However, you need to look at where trade and commercial flows are going, where financial flows are going. I would look between the Middle East and Asia as an example. Substantial increase of flows between those two regions, and they're not flows that are necessarily coming from the West, just being transshipped through those regions. They're actually wealth that is being
rechanneled in that region itself. I think you'll see that more and more. I think you'll see Asia, Middle East coming together more and more. And I think you'll have a much more balanced equation. I don't think there'll be as a dominant, source of financial flows that you've seen before. And great for us because we happen to be very strong in those two regions. But I do think people need to understand that there's a significant change going on. And those flows will not just go through New York as they used to in the past.
Michael Roberts, thank you so much for taking the time. Really wonderful to speak with you. And John, that was Michael Roberts of HSBC on some of the key topics here and the idea of how much that financial center has shifted.
Hey, Lisa, thank you. Appreciate it. More from Lisa in just a moment, so stay tuned. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. US Treasury Secretary Scott Bessent proposed a longer pause on high US tariffs on Chinese goods. This would be in return for Beijing putting off its recently announced plan to tighten limits on critical rare earths. Speaking at a news conference in Washington, Bessent said there's a very good chance that he travels to Asia to meet with his Chinese counterpart, Vice Premier He Lifeng. Elsewhere, Bank of America and Bank of New York Mellon Court were hit by lawsuits over alleged ties to Jeffrey Epstein's sex trafficking scheme. The lawsuit accusing the banks of knowingly providing financial services that enabled the scheme for years and failing to report suspicious activity until years later. And Apple's been hit with another high-profile exit from its AI division, with the executive leading its Siri search project leaving for Meta. Qi Yang headed the team developing ChatGPT-style features for Siri in a major revamp due next March. His departure adds to roughly a dozen key losses from Apple's AI group this year as Meta continues its big money hiring spree. And that should be my brief, John.
Lizzie, thank you. Appreciate the update. More from Lizzie in about 30 minutes' time. Up next, the morning calls, plus the United Airlines CEO, Scott Kirby, on the back of his latest earnings results. That conversation up next, live from New York City this morning. Good morning.
Nvidia is seeing perhaps a much bigger market than previously expected, and that's what's driving their more bullish forecast. What we're starting to see is that the narrative isn't really about the product cycle anymore. The market opportunity seems to be bigger and bigger. There's more application usage.
That was Frank Lee of HSBC looking for 80% upside on shares of Nvidia. Price target 320 right now in the pre-market, about 182. Big move. That's what him and the team are looking for. Equity futures on the S&P 500 firmer at the moment, up by a third, up by 0.5 on the Nasdaq. That's the price action into the cash open, 1 hour and 14 minutes away. Here are your morning calls. First up, Citi raising its price target on Micron to 240, expecting AI to boost long-term contracts for chips. That stock is up by 3.6%. Barclays raising its price target on Morgan Stanley to 183, citing its third quarter earnings and revenue beat. That stock inching higher by 0.25%. And third, and finally, Deutsche Bank, raising its price target on United Airlines to 125, citing a higher earnings outlook. That stock doing better as the session progresses. We're down just 0.1% in the pre-market. Let's stick with United. The airline seeing operating revenue for the third quarter fall just shy of analyst estimates, but did post better than expected full-year guidance. With the latest and with the company's CEO, here's Lisa with more. Hey, Lisa.
Hey, John, thank you so much. Yeah, I would love to welcome in Scott Kirby, the CEO of United Airlines. And Scott, it's really tremendous to see not only what you did, but also the fact that you see significant upside to the fourth quarter. And I want to just start there. Where do you see the acceleration in demand?
You know, actually, you look across the full year, the first three quarters were really good for United in a lot of macro volatility that happened for the aviation industry. That demonstrates the resilience of our revenue diverse, brand loyal business model. But you look to the fourth quarter, it's even more exciting because as the economy is starting to get back to a solid footing, at least for aviation, demonstrates a lot of upside. We think we're going to be able to grow earnings for the full year, even in this environment. So it really is creating value for all of our customers, all the way from basic economy to winning much higher market share in the brand loyal customers. Really is a great resilient strategy when times are difficult, but a lot of upside as the economy recovers here in 4Q.
I guess I want to drill into the economy because, Scott, earlier in the year, it had been the economy section that had struggled the most. I'm just wondering how much it's picking up, whether you've had to discount tickets to bring people in to compete or whether consumers are willing to absorb higher prices and just and take their trips.
Yeah. Well, as we've talked about before, Lisa, the airline industries are a pretty good real-time indicator of the economy. And, we saw for much of the first half of the year economic stress, and ticket prices were lower as a result of that. But as we got into the third quarter, bookings, at least for future travel, the economy started to pick up, bookings started to pick up. And as we finished the quarter, we've set records each of the last several weeks on most corporate revenue that we've ever booked in a single week, and a number of records, particularly in business travel. Really kind of strong across the board, though. International's come back stronger. The period has extended. Premium is obviously stronger than main cabin. But really, we've seen improvement, as we've moved through the third quarter, kind of across the board on revenue streams, with the biggest strength in the corporate segment.
And that's actually something that we see across the board, particularly because there are all these deals. So people have to actually get on a plane and go see some of their clients.
We love that.
I am wondering, are you seeing international travelers, tourists, come back to the United States? I know that was kind of a soft spot and a sort of a tell in terms of the international reputation of the country.
Well, our business is about 80% U.S. point of sale. But we saw a drop in international traffic earlier in the year. It's not quite back to last year's levels, but it has recovered, and it's close to last year's level. So we did see a dip, but even that has come back, and we think that's on the trend to getting back to normal pretty soon.
Are you planning to keep capacity pretty much the same? Are you planning to expand or cut back? I know that it was constrained earlier this year just because of demand, but as demand picks up, are you going to bring more planes on deck?
Well, we've been growing, in absolute growth, actually faster, I think, than any airline in the world has ever grown for several years in a row. And that's worked really well for United, and that's been successful. So we really haven't much changed our capacity. We tweak it here and there. The biggest change we're going to make for next year, I think, is actually to reshape the seasonality of the year. One of the things that's happened that's good for our business is this third quarter peak has extended into the fourth quarter. And it's made the fourth quarter actually a better quarter from a margin perspective than the third quarter. And what we think is, as that, particularly that international demand has extended into the fourth quarter, there's an opportunity for us to actually fly less in the peak in the third quarter, which will be good for our RASM. But it turns out it's going to actually be good for our cost structure too, because we have to build staffing and infrastructure, everything up to that peak for 6 weeks of the peak summer. And so next year we're going to actually try to reshape our schedule some to lower the peak and let the demand spread across more of the year.
I know earlier this year when we were talking, you said that you do expect to raise prices by, single digits just to compensate for higher costs. Do you see that on track, the same type of price increases, and are consumers okay with it? Are they absorbing it?
This year, prices have come down, as we talked about, as there was macro volatility, at least for aviation. I do expect them to normalize next year. And I think just over time, that you should expect to see airfares grow consistent with inflation is likely what's going to happen over time.
How much do you see staff wage increases also playing into this? The idea that a lot of the people who work for United are also saying, okay, well, things are going up. We want a pay increase.
Yeah. Well, our people are the best in the world, and they deserve industry-leading contracts. Every time we sign a new contract with one of our union groups, they expect and deserve and will be paid at the top of the industry. So that's built into our forecast. That's built into everything that we're doing. One of the great things that we're doing, though, at United is I think we're the best in the world at managing our real core costs and being more efficient at the airline. We've invested heavily in technology. It helps us run the airline better. But like you look at the third quarter, there are a number of airlines that have talked about missing their cost guidance because of storms. And there were storms in the quarter. But we've invested so heavily in our recovery tools that we had, best in the industry cost performance. And we're driving our costs lower, not by taking things away from the customer, but by actually investing in technology that lets us run a better operation for customers and is lower cost at the same time. And that also helps fund investments for the customer. We're spending over $1 billion a year in incremental investments for the customer, but also importantly, investments in our people and having them have the best pay and the best contracts in the world.
Scott, I love saying that you're my favorite economist to speak to because you do have this real-time view of the economy. And right now, what you're saying is kind of flying in the face of the weakness and some of the worries that we're hearing, whether it's from the government shutdown is going to cause disruptions or whether it's the employment picture that people are increasingly worried about. How do you square those two things, this reacceleration that you're talking about, with the weakness that policymakers seem to be so worried about?
Well, uncertainty really is, I think, what drives the economy in one direction or another. And there was a lot of uncertainty to start the year. As we kind of got into the third quarter and some of the macro issues, the reconciliation bill passed and geopolitical situation improved, tariffs settled into having some confidence what they were going to be, we saw that improve. Now, we do now have, new issues, that things pop up all the time. What's happening with the shutdown could become an issue. So far, it hasn't been. First, the FAA is doing, I think, a great job of running the system. We have our lowest cancellation rate in the last decade, our second best on-time performance. The controllers are professionals. There's not news about it, but the controllers are professionals, view their job as safety, view their job as taking care of the public, and kudos to them. Almost all of them are showing up to work and doing their job. And the first couple of weeks of October hasn't really affected bookings. I think if this goes on for too long, certainly the risks escalate in the economy as it goes on. I think the economy is better than most people think, but it's still tenuous. It's still a little balanced on a knife edge. And we shouldn't have, unforced errors. So let's get the shutdown settled.
Scott Kirby, thank you so much for your time. I really appreciate it.
Thanks,
that was
Lisa.
Scott Kirby, the CEO of United Airlines. John, I'll send it back to you.
Lisa, thank you. Great work. Look out for Lisa's work down in Washington, D.C., tracking the IMF World Bank meetings. Amazing to pair that with what we heard from Governor Waller a little bit earlier, concern about the labour market at the Federal Reserve, paired with United Airlines and Scott Kirby, pretty bullish about the future for this economy, at least for their company.
As well as Delta. They're seeing, and it's not just the premium business class seats, they're seeing demand as well from individuals that are booking economy. So they are seeing a pretty optimistic outlook. And then also when it comes to potentially travel delays, which I still think is this huge pressure point for this administration and members of Congress, right now they're saying they're able to basically muddy along, get through it. They're not seeing massive impact from the government shutdown, even though they obviously want it to end.
Up next on the programme, we'll catch up with the US Energy Secretary Chris Wright as national power costs are on the rise. Plus, Vonnie has your morning movers. Snowflake surging on a new AI partnership with Palantir. The opening bell about 60 minutes away. Equity futures into that firmer, just about by a third of 1% on the S&P 500. On the Nasdaq, up by 0.5. Outperformance on the small caps gives way over the last few weeks. Small caps this morning up by 0.37. As we count you down to that cash open, let's get you some morning movers. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John. Well, it's Thursday, so we have a partnership. Snowflake and Palantir this time reporting an AI analytics partnership. So apparently it's Snowflake's cloud and Palantir's AI Foundry operating system and its AI platform. They're coming together, and if you're a customer of both, there's interoperability. In practice, they say it's going to help you with things like AI order recommendations and also AI connected to supply lines and manufacturing lines and so on. Let's move on. Praxis Precision Medicines. This could be a very exciting one. A phase 3 study on a potential medication has met its key endpoints. Now, this would be to treat what's called essential tremor. I'm sure we all know people that have suffered from this. It's a nervous system condition, and it means essentially uncontrollable tremors. This company is looking for a meeting with the FDA to potentially start that regulation process, and you can see the stock up substantially after those stage 3 results. And then American Battery Technology. Well, this is another victim of a string of alternative energy rollbacks from the Biden era green policies and supports. This lost a grant, a key US government grant. But the interesting thing about this is that part of what it does is recycle battery materials. And if we're not going to be getting rare earths as much or at all from China, we need to start learning how to recycle battery materials if we still want to have batteries. Anyway, that aside, this stock has been up 260%, perhaps for that reason, in the last month. It's getting dinged today, though.
Vonnie, thank you. Some of the movers to look for going into the opening bell in the pre-market this morning. Let's turn to energy. As the AI chips race heats up, the Department of Energy is fighting to keep electricity prices from skyrocketing. Today, the DOE announcing a $1.6 billion loan to a subsidiary of American Electric Power. The goal is to strengthen grid reliability and, of course, lower energy costs across the Midwest. The US Energy Secretary Chris Wright joins us now for more. Mr. Wright, Mr. Secretary, welcome back to the programme, sir. Let's just start with giving you some time to explain what brought us to this moment and what the broader strategy is.
Yeah, the broader strategy is to use funds to better the American experience, lower cost of ratepayers, lower taxpayer expenditures. I mean, in short, President Trump got elected to get rid of the nonsense. We're not about climate politics now. We're about energy for the American people. How can we lower their cost of energy? How can we enable AI and manufacturing to reshore in our country? And this program, this loan is a perfect example of that. This is to reconductor 5,000 miles of transmission lines. Existing right-of-ways, existing towers, just put better conductors up so you can get more juice through the same corridors you already had. This is the kind of things that helps American people and American businesses.
Secretary Wright, your department is saying that and projecting that data centers, commercial customers are for the first time ever going to use more electricity next year than households. Is the federal government going to have to step in and help American people, consumers, foot the bill?
Well, the American government's doing everything we can to enable the growth of electricity production in this country. You know, the last administration was about energy subtraction, trying to get rid of things they didn't like and subsidize things that are unreliable, that use a lot of land and drive up electricity prices. So, yeah, we're trying to reverse a tidal wave. That's a challenge, but we're going to do it. And ultimately, AI is not going to make electricity more scarce and more expensive in the country. It's going to make electricity more abundant, more reliable, and ultimately more affordable. So we can walk and chew gum at the same time. It's a challenge, but we're going to get it done.
Well, the administration, though, has purged some clean energy projects. Do you want a whole of energy approach or just specific types?
We care about affordable, reliable, and secure energy. Yeah, I get asked all the time, aren't you all of the above? No, I'm not all of the above, and I've never claimed to be. If you put, it's not just more electrons on the grid. To collect more wind power in the middle of the night in Iowa, that doesn't increase the capacity of our grid. That doesn't drive down anyone's prices. It doesn't allow us to reshore manufacturing or data centers here. The electricity grid's very different than your gas tank. What matters is having reliable power to meet peak demand times. If you're not there at peak demand time, you don't add any value to the grid, you just add expense.
Well, when it comes to reliability, right now, the U.S. government is shut down. Are you speaking directly with senators about when the U.S. government could reopen? How is it affecting your department specifically?
Oh, that is a great question. And yes, I am speaking to U.S. senators on both sides of the aisle. The shutdown is definitely destructive. Everything we're trying to do is lower American energy costs and enable American businesses to build more manufacturing facilities in our country. Losing workers, having uncertainty, having funds frozen or uncertain, that's not helpful. If I can give one example, we are modernizing our nuclear weapons stockpile at the Department of Energy. That's done by about 100,000 contractors. They're not government employees, they're contractors. So they're not going to get back pay. We've been paying them to date, but starting tomorrow, Monday at the latest, we're not going to be able to pay those workers. If that continues on for long, they may get other jobs. They're going to stop their efforts to modernize our nuclear weapons to guarantee the sovereignty of our country.
Secretary
That's not
Wright?
Something we should mess around with.
Are you saying you are furloughing
Yes.
employees at the National Nuclear Security Administration, which keeps our nuclear stockpile in check?
We have not furloughed anyone yet, but we will be out of funds by the tomorrow or early next week. So we will be forced to do that if this shutdown continues. I desperately do not want to do that, but I have to follow the law.
Well, what does this mean for our national security posture?
Of course, we keep people for emergency services. Our existing nuclear stockpile will be secure and will be ready. But the modernization program to replace our older weapons with new modern weapons, that's a key part of my job. We're just ramping those efforts up. We're just getting momentum there. To have everybody unpaid and not coming to work, that will not be helpful. I'm adamantly in favor of ending this shutdown as soon as we can. Unfortunately, Chuck Schumer's worried more about AOC than America's nuclear safety. That's just deeply un-American. I'm very disappointed with the Democrats. We have a clean CR to just continue the Biden-level spending we had before. It's got bipartisan votes in the House and the Senate multiple times. It's just a small number of Democrats that are standing out thinking they're going to win new subsidies by holding our modernization of our nuclear stockpile hostage. This is deeply irresponsible.
We also have at this moment a current trade war between the United States and China with a lot of hot rhetoric the past few weeks. What is the department doing in terms of sourcing rare earth minerals that come from China? And China right now is trying to really put a chokehold on them.
Yes, that is another critical effort at our department and across the Trump administration. We have made ourselves far too dependent on, as you say, critical minerals and products that come from them, that come from China. We have an across our department and across the administration effort to reshore the mining, the processing, the manufacturing for these critical projects in our country or in our friends, neighboring countries or close allies of ours. This is an absolute critical effort of the Trump administration. But it's going to take time. It's years that dug us in this hole. It's going to take us many months, hopefully not many years, to get out of it. We will achieve it during the Trump administration. But you're right, we're vulnerable today. And that's at a loss to Americans. 4 years of unserious government focused on climate change and energy subtraction, outsourcing anything that consumed energy out of our country. That was deeply destructive. It angered Americans and it elected President Trump. We need to fix it.
You come from the private sector. Are you comfortable with the president taking stakes, equity stakes, in some of these companies that he deems critical for the U.S. national security?
I am. And let me tell you why. China has used market forces to push us out of all these critical industries. As soon as we invest money or American businesses invest money, to mine samarium or process that in the United States, they flood the market, drive the prices down, and people can't raise equity capital. They can't develop those resources. China has used manipulation of markets to keep us and the rest of the world out of these critical materials. We need to do things differently to make it so it does work for American businesses to do these things in our country. That means the government providing loans, the government's providing equity capital, the government's providing other out of normal market mechanisms to make it happen.
Are you not concerned of distorting the market, though? You're a capitalist. Is this not distortion? It feels like the U.S. government is doing what China does, which is picking winners and losers.
Yeah, we don't want to do this broadly in our economy, but China has effectively distorted the market to push everyone out of these critical industries. The only way for us to get back into those industries is to respond to China's market distortion, and it does require things out of the normal market mechanism. But that's in a narrow area of these critical minerals and materials, but they matter for our national security and they matter for our economic security.
Mr. Secretary, thanks for making time for us this morning. We appreciate it, sir. Chris Wright there, the US Energy Secretary, on a range of issues, including how to support the energy grid at a time of increased demand, let's put it that way, from a lot of data centers being built in this country.
Tons of increased demand. What they are projecting is in terms of AI data centers, commercial users are going to outpace what households are using. And natural gas, these prices, electricity, are going to go up. And this is where it's going to become incredibly problematic for politicians in Washington, D.C. The issue with the Trump administration, they say they want a whole of energy approach, but they seem to be picking energy they like and the ones they don't, because they have gutted some clean energy projects.
If you are just joining us, welcome to the programme. Moments ago, we also had some economic data. It came from one of the regional Fed business outlooks. The Philly Fed Business Outlook Index, a big downside surprise on that particular read, much softer than expected. Bond yields down off the back of that, just by a touch. We're down by about 2 basis points on 10s now to 4%. 2's down by a basis point at 348. Equities staying just about positive on the S&P 500, higher by 0.4%. That's the setup going into the opening bell, about 45 minutes away. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. A federal judge has ordered the Trump administration to pause plans to fire thousands of federal workers during the government shutdown. The order isn't a final decision on the merits of the case, but temporarily prohibits over 30 federal agencies from sending out layoff notices. Some 4,000 notices had already been sent out since last week. Elsewhere, President Donald Trump says that he's authorized the CIA to take covert action in Venezuela to stem what he says is the flow of drugs and illegal migrants into the US. He was responding to questions about a New York Times report which says that the agency would be enabled to carry out lethal operations in Venezuela. And finally, Israel has threatened to resume attacks on Gaza if Hamas does not follow through with all of the steps outlined in President Donald Trump's peace plan. Israel's military has been ordered to prepare if the militant group does not disarm and return all the bodies of the dead hostages. Hamas has so far released the remains of 7 hostages, leaving 21 unaccounted for. And that's your Bloomberg Brief. John.
Hey, Lizzie, thank you. Appreciate it. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Subhadra Jabra of SocGen, looking ahead to a Federal Reserve meeting at the end of this month. We'll break down the latest from the Fed and our interview with Governor Chris Waller. From New York City this morning, good morning. You're watching Bloomberg TV.
In terms of inflation, I mean, one of the things I was asked this question by some people in the AI sector. It's like, isn't this inflationary, all this spending we're doing? I said, yeah, but you're taking it away from other sectors. So those other sectors are seeing less demand. So this is, in my view, a lot of this is a sectoral reallocation. And if that's the case, then the increase in AI is going to be offset by other things.
Thoughtful conversation with the Fed Governor Chris Waller on the future of policy, the meeting that's taking place at the end of the month, and the force of AI and all the spending taking place in this country and whether it complicates the outlook for monetary policy or not. See more on that on Bloomberg.com and on the Bloomberg terminal for the full interview here on Bloomberg Surveillance. From New York City this morning, good morning to you all. Equity futures on the S&P 500 firm are going into the opening bell 43 minutes away, up by 0.6% on the Nasdaq 100. As we count you down, a sneak peek at a week ahead for you is shaping up as follows. Today, a slew of Fed speak, plus an announcement from President Trump at 3 p.m. Eastern Time, so stay tuned for that. On Friday, President Trump meeting with the Ukrainian leader in Washington. Then into next week, tech earnings begin. Numbers from Netflix on Tuesday, Tesla on Wednesday. Plus, we will get that CPI report on Friday.
And that might actually be very complicated for the Fed because they might only have that in terms of the government data. Because if the government continues to remain shut, which, I mean, we just heard from Secretary Chris Wright, doesn't sound like they're making progress, no side is blinking, then they're going to potentially have this hot CPI print and not the labor market data to back up the cut. Governor Waller, though, made a very succinct argument as to where he's seeing weakening labor markets outside of the BLS reports. So likely the cut's going to happen, but it's going to be a little awkward.
It's slightly awkward. It's uncomfortable. You might be cutting interest rates when inflation's at 3% and you haven't got clarity on the jobs market, complete clarity on the labour market, given the shutdown and the lack of data. Let's stick with the data. Subhadra Jabra of SocGen writing the following. Treasuries are in a bit of a holding pattern as we wait for the government to reopen. While there are some alternative sources of data for the labour market, it is hard to get a good read on inflation. Subhadra joins us now for more. Subhadra, good morning.
Good morning.
We will have the inflation data next week. Will we have some clarity once we get that?
Definitely better than what we have right now, which is nothing. So I would say that we need the inflation data. I'm more concerned about inflation read for the subsequent months because the surveys will not be able to be made on time. There's going to be delays for several months, perhaps, on the data front. So that's really going to muddy the picture for the Fed. So as far as the employment picture is concerned, I think that they have a pretty good read. The Fed, especially the regional Fed presidents, talk to all of their constituents. They have a good sense of where employment is headed. I think inflation is a little bit more tricky.
I'll ask a slightly provocative question. You can give me a serious answer, of course. But does it matter if they have the inflation data or not? Because the way Chairman Powell set us up, he set us up to ignore it, hasn't he?
For the October meeting, it probably doesn't matter. The December meeting, I'm sure they will definitely take all the data that they have into account before they proceed. The market, of course, is pricing in a very aggressive path of cuts between now and the end of next year. We have the terminal Fed funds rate that the market's pricing in is below that long-run neutral rate that the Fed has penciled in. So that's a very aggressive policy easing without not much by way of data. So the market, I think, is reflecting a relative level of caution and perhaps of a feed-through from this government shutdown into the broader economy, as well as, a change in leadership next year.
When it comes to the pass down of what's going on with the government shutdown, most economists just brush it off. When do you think we would see long-term impacts?
You will see long-term, typically what happens is that the impact tends to be quite minimal because of the fact that the shutdowns never last that long. This is a very unusual time frame. Even back in 2013, where you had that sort of debt ceiling deadline as well, the shutdown itself wasn't that long. And last time it was a partial shutdown, so we were getting a lot of the data that we needed. This time around, I think that the impact could be a little bit more profound. Although a lot of that, when the government reopens, you give back a lot of that, but there will be some permanent losses. So it is worthy of our attention.
When Fed officials speak, and Jay Powell speaking, Governor Waller speaking, it sounds like they're talking exactly like they did in the setup to the September meeting. You're saying December's more important. What are you going to be looking at between now and December?
So to me, it feels like it's a little bit of a K-shaped economy, right? Where even in the beige book, if you look at some of the data points you got, I mean, luxury spending is still very healthy. The high-end consumer is spending a lot. You're seeing that in general, the upper half of the economy or the consumer is doing really, really well. The lower half is really struggling. So in some respects, the Fed seems to be more focused on that, on the lower half, if you will, on the job front as well as on the broader health of the economy. But financial conditions are extraordinarily easy, so that makes it very, very tricky. Inflation is going to start becoming a concern if financial conditions remain as easy as they are, and the Fed continues to preemptively cut rates. So to me, inflation is still a concern, and I think the Fed's going to have to be very cautious.
It is really peculiar to have the conversations we've had in the last 60 minutes, to hear from Governor Waller legitimately concerned about the step down in payrolls growth, and then for Lisa to speak to Scott Kirby of United Airlines talking up this reacceleration of the economy into year end. I understand the explanation for it. It's just peculiar. Now, when I look at market pricing, clearly we're priced for more interest rate cuts. The 2 years anchored around 350, has been for a while. Tens have come down to 4. It's the longer end that I think is a more interesting conversation. If, as you expect, inflation becomes more of a problem, if I can call it that, what does that mean for the longer end of the curve?
So you should expect the yield curve to continue to steepen as the Fed is cutting rates, but inflation expectations really haven't reflected that concern. If anything, survey-based measures have shown some level of concern, but market-based measures of inflation have remained relatively contained. So the market is very aligned in thinking that maybe you don't see core CPI go above 3%, maybe core PCE stays between 2.5% and 3%. So there's a case to be made that the Fed focus more on employment. But we haven't really, in my view, seen the impact of tariffs feed through into inflation. You are seeing higher goods inflation. You're seeing inflation feed through into certain sectors, but it's not really as broad-based as you would expect.
What explains the spread between survey-based inflation expectations and market-based inflation expectations? What explains the difference?
So to me, I feel like the market-based measures of inflation reflect a level of Fed credibility. The Fed's been very, very credible. So if there is a turnaround in inflation, they're going to actually either pause hikes or pause cuts or perhaps even hike if necessary. So the Fed has a lot of credibility in fighting inflation. So I think that that's part of the reason why the market-based measures of inflation have remained relatively contained. The survey-based measures of inflation reflect a variety of factors. It is the prices that the corporations are having to pay. It's also the fact that energy's been a little bit volatile. Energy prices are going to also be reflected in the survey-based measures of inflation. So it's a bit more of in some respects a better read in my view of inflation.
When you say tariff impact hasn't been we haven't seen the full effect. When will we?
That's a very, very good question, and it's been very, very difficult to answer because you've seen these staggered, tariff announcements. I mean, over the last, I'd say, week, we've been focused on tariffs on China, how that feeds through, and the impact in the stock market, but it's not been really a consistent story, and the average, tariff rate's been somewhere around 15%, which is still a relatively low rate. And we've been kind of delaying some of the tariffs on China. So, it's very, very hard to get a good read on what that impact is going to be.
I'm counting the amount of equity strategists that have come on and said the same thing. David Lebovitz of JP Morgan in the last hour or so. Lori Calvert-Senior of RBC has been so consistent on that matter too. They're waiting for it to bite. Waiting and waiting and waiting, and they expect at some point in the next few quarters you're going to see corporations have to make a decision.
There's also a recent survey by Deloitte talking about the anxiety around shoppers going to the holiday season. Some of these shoppers are saying they're actually going to pull back And if we see higher prices, say, going into Christmas and the holiday season, will that be the shoe to drop when it comes to tariffs? But how do you even know when the two biggest economies are negotiating right now, and that story has a 2026 potential end date, not 2025.
Could change all again at the end of this month. Subhadra, it's good to see you. Thanks for dropping by. Subhadra Japa there of SocGen. Rounding up the programme this morning, plenty to talk about. A Federal Reserve on track to reduce interest rates again at the end of this month. The conversation with Governor Chris Waller teeing up another 25 basis point move.
Teeing up another 25 basis point move. And Jonathan, once again, he said he didn't want to brag, but he is vindicated. Jay Powell basically took his entire analysis and thesis at Jackson Hole, and then that was it. They were off to the races to cut interest rates. Even without the data, they can fly blind for September. I think it makes it a little bit more challenging as we go towards the end of the year.
We certainly want some more data. Coming up tomorrow, we'll catch up with Matt Miskin of John Hancock Investment Management, Liz Ann Saunders of Charles Schwab, Steve Rasciuto of Mizuho, and Mark Haefele of UBS. From New York City this morning, good morning to you all. A special thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.